Assalamu alaikum. Hello and welcome to all of you today in this first session in a two-part series on financial statement analysis. As you are all aware, this is an extremely important topic, irrespective of whether you are working purely in the accountancy field or in audit, in advisory, consultancy, wherever you are. The importance of financial statement analysis cannot be stressed enough. As you would have read in the invitation email, this training program is structured in a two-way series. In the first part today, we will basically be focusing on some of the basic concepts, where we will be going through various analytical tools, including valuation analysis, and vertical analysis. We will be using a real-life example. Just bear with us. We will be using a real-life example of financial statements to actually run through these tools. Then, in the concluding part, we'll be having a different format where another professional will join me and will focus on more high-tech aspects of FSA, building upon from these very basic concepts. So thank you for joining us today on a Saturday morning. Let's begin. Bismillahirrahmanirrahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. O Allah, open my heart and ease my task for me and remove the impediments from my speech so that they may understand what I say. Some of you would already know me. Those of you who are joining for the first time in a session, I'll quickly run through my introduction. I'm a highly IT literate and experienced accounting, finance management, and economics professional. Honored to be an FCCA fellow, chartered certified accountant, holding the CFA charter, anti-money laundering specialization, BSc honors in applied accounting, and several other professional certifications, mostly from UK, along with 16 years of experience gained in top management positions in leading British as well as Pakistani organizations. At the moment, I'm serving as the managing partner at Millennium Law and Corporate Company, which happens to be the pioneer ACCA and legal practicing firm in Pakistan, and also serving as a director on the board of various corporations. With regard to trainings, I'm honored to have conducted mandatory promotional trainings of government officers at MPDD and have been working with esteemed organizations in corporate, public, and academic sectors. Some of the other core institutions I've worked with include National Bank of Pakistan, HBL, Lahore Tax Bar, Karachi Tax Bar, Lahore, Karachi Chambers of Commerce and Industry, Bangalore University, UET, MPDD, and last but not the least at all, our very own ACCA. Besides being a chairman of ACCA's MNP and Taxation Committee, I'm also honored to be representing Pakistan on the Global Tax Forum. For those of you who do like to read, I'm a regular contributor in various English language dailies, mostly writing on these technical subjects related to our field. I'm a life member and 4-time serving chairman liaison committee of Lahore Tax Bar. I'm also a member of the Professional Expert Forum, been working on several initiatives with Lahore Chamber, sitting on several think tanks, etc. So I think that's pretty much about me. You will have this intro. These are some of the key existing associations and just a listing of professional and academic qualifications. And this brings us to the thick of things, the table of contents. We'll begin with the annual report. Almost all of you, I'm certain, do know what the annual report is, and I'm hoping that most, if not all of you, would have seen the real-life example of various corporations' annual report. We'll then move on to ratio analysis, go through some of the more common ratios that are used in industry, and we'll be looking at them from two different perspectives. Number one, which financial statement they belong to, and number two, what purpose do they actually serve. We'll also discuss about horizontal and vertical analysis. We'll then quickly discuss a comparative between these two. And although we have listed Q&A session, question and answers, as a separate segment, but we'll be having the regular question answers break. So I suggest if you have any question, just note it down in your notepads And when we have the question and answers break, just quickly write it down there. Okay, so let's begin. The PDF file.
Yes, it's in the download folder. This one.
Thank you. Okay, have you shared this already?
I have uploaded.
Okay, you should be able to see this PDF file, which is actually the annual report of a corporation, in the handout section.
It's currently 63% uploaded.
It's uploaded.
It's about to be uploaded, so you'll have this available. Just a quick look of what the real life annual financial statements look like. I'm sure many of you would have heard about the integrated reporting being the hot topic nowadays. So this is also a good example of how integrated reporting is working in practice. So just a quick look. You can see on your screens the table of contents of this annual report. First of all, it begins with an introduction of the company, its objective, values, geographical presence, SWOT analysis, organogram, etc., etc. Then it moves on to the corporate governance structure, which also include the CSR report, corporate social responsibility, the stakeholders engagement, pattern of shareholding, categories of shareholders, etc., etc. Then it also has fulfilled the legal requirement by including the notice of annual general meeting, the management report and reviews, which includes the top management's profile and the director's report, which outlines the future vision as well as the performance in the last financial year. Then now most of the corporations, especially the large ones, do this, that they provide you the analysis themselves. So you have the 6 years data, important ratios, vertical analysis of both the major financial statements, balance sheet and P&L. You also refer to it as the income statement. You also have the horizontal analysis of the same, the statement of value addition, quarter-wise analysis, DuPont analysis, etc. So although you are provided with these analyses, but during the course of your work, whether it's for advisory, certainly during audit, just your accountancy work, it's always advisable and best practice to perform your own calculations anyway. So then you are also provided the share price sensitivity analysis, and then finally you have the set of financial statements starting with the auditor's report. That is because this is a large corporation and the part of a very large conglomerate group. So you also have the consolidated financial statements, and that's it. So that's pretty much about the intro of the annual report. Let's move on. Okay, this presentation includes some additional slides which are not in the table of contents and which are not within the scope of today's session. I've left them there as a gift for you as a knowledge sharing tool. These focus on various basic aspects. What is the prime purpose of these tools, these analysis, the annual report, financial statements, common concept you'll be very familiar with, accounting earnings income versus cash. So the cash flow statement, direct, indirect methods, cash flow statement analysis, the income, profit and loss account, balance sheet, etc. So just run them through. If you feel the need, you can also share this with your friends who might need it. And you do have the annual report available in the hands out section now. So first things first, just a quick question. What is the difference between accrual accounting and cash-based accounting? It's a very basic question, and I'm sure all of you would be aware. So if you could just quickly type and share your response. We have hundreds of participants and nobody knows the answer. Khayyam is itching to give me an answer, but he's not allowed. G, again, very quickly. What do you think is the core difference between accruals-based accounting and cash accounting?
SMS has replied that key difference is the timing of recording.
Where are the answers in the chat section?
Question.
Okay. Yeah. Oh, now we have the responses flowing, right? Okay, so Ijazul Haq, accrual accounting takes care of that expense relating to particular period gets booked in that period, whether cash has been paid or not. Asma, accrual-based accounting matches income and expenses of same period irrespective of cash flow. Hassan, key difference is timing of recording. Fatma's accrual is expense incurred based and other is cash based. Okay, pretty much very good. Different ways of expressing though. So you do have the concept. In accruals, whether cash is paid or not is irrelevant. The transaction is recorded in the period in which it is incurred. Needless to say that cash-based means the transaction, whether income or expense, will only be recorded when the cash transaction takes place. So let's begin with ratio analysis. What is ratio analysis? I mean, we all know ratios. We have studied that during our examinations of ACCA. Most of us have been constantly applying that in our practical field. So when you hear the term ratio analysis, what is the first thing that comes to your head? Okay, we are still getting answers for accruals. Thank you very much. That is done. So now a quick answer, ratio analysis. Okay, comparison of different items. Fatma, performance analysis. Osama, comparison of figures to benchmarks. Muhammad Ali Sheikh, Amjad, comparison, giving meaning to numbers. Snapshot picture of company performance to measure certain progress of company, etc., etc. Okay, that's pretty much it. I wanted to have an idea. Some of you do have the idea of the ratio analysis. Others are actually confusing the uses of ratio analysis with the ratio analysis itself. So let us quickly run through the formal definition. Basically, ratio analysis is a quantitative analysis tool or technique in which we analyze the information contained within the financial statements of a company or any form of business. These ratios are categorized in different manners to analyze the various aspects of a business, such as the profitability, the liquidity, the efficiency of resources utilization, the assets that are deployed, solvency, etc. So if we want to put a formal definition to it, we can very easily say that ratio analysis is a method or a process by which the relationship of various items or group of items in the financial statements are computed and presented. All the other things that were being shared in your responses, such as making meaningful comparisons, comparing with the benchmark, making the information meaningful, etc., etc., are the uses that are derived from this ratio analysis. So ratio analysis is a very important analytical tool for financial analysis. It is used to interpret the financial statements so that the strengths and weaknesses of any business, its historical performance, and current financial condition can be determined. Normally, some of the core objectives of performing a ratio analysis exercise are to standardize financial information for comparison. What do we mean? There is a Microsoft having a turnover in billions of dollars. And then we have a small, recently started corporation in the IT sector somewhere in the third world, let's say in Pakistan, for example, which is doing very well, but perhaps it has a revenue at the moment of a few millions, or let's say 100 million rupees. Now, how do you compare that? The profit of Microsoft, let's assume $30 billion. The profit of this corporation, 50 lakh rupees. How do you compare 50 lakh with 30 billion? That's where the ratio analysis comes into play. You use various analytical tools. Okay, just a quick example, you can use gross profit margin, net profit margin, that, okay, the profit margin of this Pakistani company is 50%, the gross profit. The net profit margin is, let's say, 40%, 30%, whatever number you want to put in. Let's say Microsoft's gross profit margin is 40%, the net profit margin is 20%. Now you can see that although the sheer volume of Microsoft is manifold, but this small startup or maybe new IT company is giving better results using the resources that are at its disposal. Obviously, needless to say, you can't just analyze with these two resources, two ratios. You would need to go through the entire ratio analysis and couple it with other tools as well. But this is just to give you an idea how the information contained in financial statements is kind of standardized using ratio analysis, particularly when we are dealing with corporations that vary in size drastically. Ratio analysis is also used to evaluate the current operations. You use the efficiency ratios, as we'll be seeing, to analyze how effectively the current operations are running and how effectively the resources deployed are being used. One can also compare the performance with the past performance to see whether we are improving or deteriorating. But there is a word of caution here. While one is analyzing the results, we need to keep an eye and find out the actual factors, as we will be doing shortly, to determine whether an improvement or deterioration in the result is due to the actions of management, or at least controllable factors, or owing to factors which are just beyond any control. For example, the petroleum products prices have been increasing in the international markets recently, right? So now, if we have a corporation dealing in petroleum products and we look at its results, we'll say, wow, amazing, profit margins improving, gross profit margin fantastically up, net profit margin increase. But hang on, was that due to some good deals negotiated by the management, some improvement in the efficiency of the operations, or it's just purely because the market factors have ended up increasing the prices of the products, because of which everyone has benefited in the sector? If the latter is the case, then that is not purely due to management action, and you still need to analyze your own operation to see where there is a room for improvement. Then we can compare performance against other firms or industry standards, as some of you shared when I asked for the definition of ratio analysis. You compare the ratios with the benchmarks to make the analysis actually meaningful. It can also help to study the efficiency of the operations, as we discussed, as well as the risk involved in the operations. So let's start. I've told you that ratios can be categorized in many different ways. What we have studied mostly in our ACC studies is the way mostly they are categorized, and that is by their purpose: profitability ratios, efficiency ratios, liquidity ratios, solvency ratios, etc., etc. But ratios are also categorized in terms of the financial statements they are taken from. So let's start with the current ratio, the one I'm sure most of you would be familiar with. Extremely simple formula: current assets by current liabilities. It's one of the balance sheet ratios and serves the purpose of finding out the liquidity. Now, why is it important to find out the liquidity of any corporation? Just a quick response, please. Why do you think finding out the liquidity of any business is important? I mean, your business is profitable, fantastic, right? Why would you worry about liquidity? The money is going to come to you sooner or later.
Can you please remind them to type their answers in the questions dialog of people sending me emails?
Okay, just a quick reminder. You need to type your response in the questions section. You can see that on the control panel on your screen. Some of you have been sending their responses by email to Head of Member Affairs, Mr. Harun Jan. Kindly send your responses in the questions box. Thank you. Okay. You're welcome. Understood now of the. So we have the responses coming in. Ahmed Kamal Khan is saying, speed is now good, it's going up. It has the basic ability of the company to repay its short-term liabilities, to ensure capability of paying operating expenses. Money is important to run the business, to determine the organization's ability to pay current liabilities when they fall due. It helps to evaluate the company's current standing and future cash flow projections, because we need to know that either company has. Very good. Most of the responses are absolutely correct. Liquidity is very important because, as per some studies, out of the new businesses that are started, more than 70%, and as per some empirical studies, up to 80% fail, not because they are not profitable, not because they do not have good prospects or good management otherwise, but because they cannot manage their credit effectively. It does make sense, all of you are aware, even if you are profitable but you don't have the cash when the bills are due, how long will that last? Eventually you'll be forced to wind it up. So yes, we need to focus on liquidity to ensure that we are managing our credit effectively. We have the cash available when it's needed. We are not certain in terms of a going concern, and while remaining profitable, we are also able to get back the cash as quickly as possible. So this current ratio is an important balance sheet ratio, which is normally categorized as a liquidity ratio, and it measures the ability of a business to pay off the short-term liabilities which are due in the next 1 year using the current assets. So let's start doing some number crunching. Just a very quick rule of thumb. The current ratio would vary industry to industry. One size does not fit all. For example, if you are dealing with the manufacturing sector, they have a large buildup of stock inventory and would definitely have comparatively higher current assets as compared to, say, a service sector firm, which wouldn't be holding any large stocks and would possibly have very low current assets level. So when you'll be looking at the manufacturing sector, the current assets would be higher. Consequently, it is likely their current liabilities may or may not be that higher. So the current ratio for manufacturing sector would be very different from the current ratio of the service sector. So what is the way to go about this? You are all very aware. First of all, focus on the firm you are operating. Focus on the industry of the firm that you are researching, which industry the firm is operating in. Then focus on the key vitals of that industry and analyze as per the requirements of that industry. Normally you have the industry benchmarks, but in Pakistan we do face a problem that varying for some major industrial sectors, the industry averages are not commonly available. One of the more practical tool that you can use in those circumstances is do a little bit of hard work, find out top 10, 20 companies in that sector and perform their ratio analysis and use that to average and determine somewhat the likeliness of a ratio for the industry, an average. That would be an approximation, but should serve the purpose better than no industry average. Okay, let's quickly do this and can I increase the size of this while being full screen? Yeah. Okay.
Are you full screen?
Hmm.
Full screen, you go back and on and pitch.
Okay. You all have this available with you. So I suggest that just open the PDF file on your system. This is the annual report for a corporate entity, and we are going to go to the financial statements section. And this begins on page number 99. So first things first, the current ratio. Can you all very quickly compute current ratio? And I think 1 minute should be sufficient. Yeah, time starts now. Please calculate the current ratios for both the years. I'm sure most of you would have computed it by now. So let's move forward to the actual thing that I want to show you. You have to type the year as well. Only 3 people? Come on, guys. This is like the most basic ratio. The ratio we first ever read. It's like entrenched in our subconscious. 4.77? Okay. Please scroll the page to current assets. Hassan, you have the PDF file available in the handout section. Just click on it and open it for your convenience. By the way, I have opened the relevant page. Oh, sorry, it has moved down. Thank you for pointing out. There you go. Non-current assets are your long-term assets, your current assets are there. You need to be careful not to take the total figures. Okay, now that you have done this, we can see that the ratio for this year is 4.77 roughly. The ratio for the last year was 5.39. So we can see that there has been a slight decrease in the current ratio, right? Now we need to find out why was there this decrease. The first things we all know to look out for are the changes in the figures. So the current liabilities have increased, okay. The major increase has been in the trade and other payables, okay. So what happened? Am I building some stock? What's happening? Let's quickly look at my sales figure. Has there been a drastic increase? No. The sales has remained largely the same. There has been slight decrease in fact. So why my trade payables are increasing? I need to find that out. Let's quickly have a look. It's note number 11. So I need to go to note 11. Currently I'm on page 102. It was 130. Okay, trade creditors include amounts due to related parties amounting to 115.447 million. Okay, so now I know at least one of the reasons of the difference in the trade and other payables. So my trade creditors have almost close to doubled. And when I go to the sub-note for trade creditors, I can find that this is largely due to, the increase has been largely due to a phenomenal increase in the related party transactions. Okay, that's one thing that I can take note of. The other figures, infrastructure cess, advances from customers are largely the same. The worker profit participation fund and welfare funds have increased, and excise duty has increased, withholding taxes. Okay, these are taxation, you have to live with it. Advances against scrap sales, sale of scrap, okay, and unclaimed. Okay, so what I can do now is I can individually also go through and investigate these figures. The one thing that I can quickly take with me is that due to the related party transaction, there has been a major increase in the trade creditors. That's fine, that was on the credit side. What about the asset side? So my current assets have slightly decreased. So what was the reason of the decrease? The stores, spare parts, etc. have decreased slightly, but the decrease hasn't been that enormous to justify the overall decrease. But my stock in trade has actually decreased. That is one thing which I would definitely like to investigate, why my stock in trade has decreased. And I've also noted already that my level of sales has also slightly decreased. So I need to club these factors together. I need to go into note 22 and have a look at what was the reason. Why did the current assets level, the stock level decrease? Is it because the market has saturated, my sales level has dropped, or is it because I had built large inventory levels last year anticipating the increase in the sales this year, and now I'm eating into that inventory that I have built? I just need to find out the reasons so I can analyze whether the change in this current ratio has been due to the factors which were controllable or not, and whether this change actually implied that the management has been a bit off the mark, or it is just in line with the policy. Once I have this information, then I can make my mind up and I can take the appropriate action. So next up is the quick ratio. You are all very well aware of the quick ratio. The same concept as the current ratio, the only difference, we take out the inventory. Why do we take out the inventory? Anyone? I mean, come on, inventory is our major current asset. Why would you like to take it out while performing an analysis on the financial statement? Just a quick hint, needless to tell you that we are analyzing the liquidity here. Okay, we are starting to get some responses. First one is Muhammad Irfan Awan. Why we are including tax refund and tax liability? Okay, because that was part of the current liabilities payable within 1 year, right? So current liabilities are to be included. But I would suggest that you hold your questions. We'll be having a quick question answer session shortly, and we'll have them regularly so you can ask all your questions there. Right now, just answer my question, please. Okay, so Muhammad Ali Sheikh, less liquid. Hassan Roza, inventory is less liquid. Anis Das, not really immediately saleable. Fatma Asghar Bharti, stock is slow moving, not that current. Ali Zahir, inventory is lesser liquid. Muhammad Awais Khan, as name states, only current assets that can be quickly transferred into cash. Okay, very good. Most of you have covered the relevant aspects. There are actually multi-facets to this particular concept. Yes, inventory is less liquid. So what we are doing a litmus test that, God forbid, if we have to immediately pay off our current liabilities by selling our current assets, what do we have at our disposal? With inventory, the problem is if you want to sell that immediately, you have to do one of the two things. Number one, you have to take the chance, just wait, somebody may come, fingers crossed, and hopefully buy it off. But if that doesn't happen, you are in a quagmire. What to do now? What's the other option? You have to sell it at seriously reduced prices. Most of you would have seen in high streets 70% off, season clearance sale, one-time sale, store closing down, etc., etc. What's that? The effort to clear the inventory. Why do they have to do that? In order to attract people to ensure that the inventory can be cleared out in that limited time. So while this strategy does allow to clear the inventory very quickly, sell it very quickly, the problem is that this is normally achieved at very reduced levels as compared to the actual prices that you would have expected and on which you would have made your other sales. So that is the dilemma with the stock. In short, most of you are absolutely right. Inventory is not that liquid. It is comparatively slow moving, and you cannot put a timeline to it that how quickly the inventory would sell and you would have the prices. So the idea with quick ratio is a litmus test, a more stringent test to find out whether the companies or the business which we are analyzing is in a safer state as with regards to the liquidity. So the quick ratio basically indicates the companies or any business that we are analyzing, that business short-term liquidity. It measures the ability of a business to meet its short-term liability and obligation with its most liquid assets. Therefore, it excludes the inventory, which is also referred to as the stock in trade, from current ratios, which would make sense that quick ratio would almost always be, in fact, always be less than the current ratio. If a business has no inventory, they would be equal, but a quick ratio can never be more than the current ratio. The quick ratio is more conservative or on the safer side than the current ratio because it excludes inventory. It derives the name from the fact that assets such as cash and marketable securities, and even factors to that respect, are quick sources of cash. Inventories, as we discussed, generally take more time, and you can't even be certain how much time to be converted into cash unless sold at disposal prices. So just very quickly, I would like you all to compute the quick ratio. Again, you have 1 minute. Your time starts now. Last 20 seconds. And mashallah, we have got many responses by now. Good, good, good. Bilal Hidayat is the first one. 2015, 4.04. 2014, 4.55. Rest of you, what about you? Hayan has shared 4.593. But Hayan, you need to mention the year you have computed this for. I'm assuming this is for 2014. Okay, guys, the time's up. If you have computed, just type the answers in the questions section. Do not send it in an email to the members helpline. Faisal Manzoor, 4.4 and 5 respectively. Muhammad Mushtaba, 4.59 for 2015. Aftab Barkat Ali, 2015, 4.04. Umesh Sheikh, 0.96. What's happening, guys? Why all your ratios are so different? I think let's quickly compute to have a look. Let me just compute it quickly here for you. Let's compute first for 2015. So we have our current assets 32,068,626 minus we have the stock in trade. Remember, you have to take out the inventory. Inventory is the stock in trade. 1348742. Even by the argument that inventory and stores are less liquid, some analysts recommends that you also take out stores, spare parts, and loose tools. But right now, we would stay with only taking out the inventory, just to show you how it works. So this is the net figure of the current assets we have, taking out the inventory. Then we have our current liabilities. So divided by the current liabilities level, and this is 5.17. That is for 2014. Let's move on to 2015. Do remember, when you are performing the ratio analysis internally for various purposes, for advising your client, or maybe you are in a bank for approving a loan, whatever purpose, as long as it's internal, you can take various variations. For example, if I was doing this internally to advise the client on their liquidity situation, I might have preferred to take out the stores, spare parts, and those tools too. But when you are performing this as part of a statutory reporting assignment, you are completing the financial statements to be submitted to SEC, FPR, etc., then you can't use your discretion. So the prime difference is, if the purpose is internal, it's customizable. If the purpose is external reporting or to comply with the statutory requirement, you can't be lucrative in terms of using your own discretion. So let's divide it by, let's do it for 2015 again. 31426,342. We take out the stock in trade, 1188,376. We have the net stock figure. Then we move on and divide it by the current liabilities, 6583476. So we have 4.59, and I think we computed just over 5 for 2014. Again, we can see the quick ratio has also declined for 2015. Now, again, we would need to investigate why this happened. Remember, ratio analysis is just the starting point. First of all, I would compare this with the last year, like I just did. It has decreased. Then maybe I'll compare it with the industry average. Where am I standing? Is it good or bad? I might compare it with my projection, my forecast for the last year, this year that ended, 2015. Maybe I forecasted it to be 5. Why was it forecasted to be 5 but ended at 4.77? Were there any factors I did not account for, or was the performance really sloppy? I need to find that out so that the corrective action can be taken. Now, again, because we have already done that for current ratio, I'm not going to do this again, but you know how to work it out. I'll quickly have a look and I'll see my current liabilities have substantially increased. And when I analyze this further, I can see that the trade and other payables have increased. Then again, I'll go to the note 11 like I did before, and I'll find out that is largely due to the related party transaction. Then I can see my accrued finance costs actually decreased. I'll go in the note and see, and you'll find out that there were some major repayments of the scheduled loans of this company. That's why the finance costs have come down. Short-term borrowings, they have decreased for the same reasons that, and current portion of non-current liabilities for the same reason that I told you. Similarly, we'll go and investigate the change in the current assets, which is not that huge, but there has been a decrease. And I can see there is a decrease in stores, spare parts. There is a material decrease in stock and trade. Again, I would need to go to note number 22. In fact, why not let's quickly have a look at note 22, since it's coming up again and again. So here we are. Now you can see there is actually a slight buildup of the raw materials. Interesting. But then I can see that the packing material, including the in-transit amount, which is nil for this year, but was 5.027 million for 2014, has actually dropped, right? So I can see there is a 5 million difference owing to the packing material in transit, which has now all been properly accounted for, and there is no more packing material left in transit, but that only justifies 5 million. And remember, these all figures are in thousands. So this means I've only reached the level of 211. 75 million is still a major difference in terms of the packing material. So I need to find out by talking to the management, going through the company's other available information, why there is a decrease of 75 million in the packing material. Has there been a new machinery being deployed? The packing strategy changed? There is lesser packing material to be consumed, or what's happening? Similarly, I can see that the work in process has decreased and the finished goods level has also decreased. So now I need to further investigate it. One possibility can be that last year I built the inventory, the business built the inventory anticipating the increase in the demand, and now the previous inventory is being consumed. And as a result, we ended up having lesser inventory because there was a huge demand. However, if that would have been the case, the sales for this year should have been much more. But if we go back and look at the income statement, we can see the sales level is largely similar. If anything, it has slightly decreased. So I can go in note number 27 and see why the sale has decreased. Now you see how this works. The ratio analysis computation is very basic thing. It's just the beginning. You then need to investigate, find out the reason, correlate the information of various figures, various ratios, and then you have the final picture in front of you. So with this, I think it is time to take some of your questions. So if you have any questions, please feel free to ask now. You have 1 minute to write down your questions. Your time starts now. You do here, if you have any. I don't think you will have any. Can we use ratio analysis in non-profit organization? Obviously you can, because even a non-profit organization whose prime purpose is to serve the social goal that they are focusing on still requires to be in surplus, if not surplus, then at least breaking even, so that it can sustain itself and fulfill the social requirements and objectives that it has set for itself. So yes, ratio analysis is very much useful for non-profit organizations. Hello, I cannot open the file from the handouts, Khwaja Muhammad. I think it must be an error at your part, because I have just tried opening it and it's working fine. It's opening. There's no issue. So I suggest just try it on a different computer, or do we still email them after this
Browser
session?
settings, their browser settings are probably different.
Okay, you need to work on your browser settings, just make sure it's compatible. What does related party transaction has to do with ratios? Umair Sheikh, oh, that's a very good question, Umair. Actually, when we investigated the reason for the change in the ratios, there we found out that a large portion of the change in current liabilities was owing to the related party transaction. Now, it gives us an idea. If we just looked at the ratio, it appeared that there was a large change. Why? Because the current liabilities increased. What would you have thought looking at that? The current liabilities increased. Fair enough. But why did they increase? Have you been more conservative with your payment policies with regard to suppliers? If that was the case, why? What's the trade case for that? What is the reason? How is it helping your business? Or is the management being sloppy? But when you actually investigated, none of those reasons. It actually was on the higher side because of the related party transaction, just intra-group transactions. And you do know the concept of substance over form, which clearly states you have to go on the actual substance rather than the appearance, the form of a transaction. So when you take out the related party transaction, you are better able to analyze the actual level. And then you can find out that, okay, this major increase largely was due to the related party transactions. Hence, it was not due to any change in the trade policy or due to any change in the strategic management, the direction of the company, or even the operational level management was not sloppy. So this actually helps you identify the key areas as a result of the ratio analysis and decide the policy, what you want to do with these results in terms of improving your businesses or improving the operations of your business. Remember, ratio analysis is a tool. It's just the starting point. The main purpose of this entire analytical exercise is to analyze your business, to drive meaningful information so that decisions can be taken, so that the business can improve. You just don't need the numbers only. The numbers are just the starting point to reach that destination. And this is how it's normally done in practice. Faisal Manzoor, will we be looking at financial statements of financial services industry? Unfortunately, not today, Faisal, but in our next session, the one that we are doing on the advanced level of FSA, I have suggested this to our other presenter who will be joining, that there should be a real life example from financial services sector, ideally a bank, but it's a bit premature. I'll try to get it by then. Let's see. Hassan Raza, in my company, we have both ratio less than 1. Still, we are getting bank finance. What bank considered to sanction loan? Hassan, this is also an area that we'll be covering in the next session, but I'm also working with several financial institutions. So I can tell you it's not just merely the liquidity ratio. And plus the liquidity ratio less than 1 doesn't necessarily mean it's a bad thing. As I've said in the intro, for ratios, you have to focus on the industry that you are operating in. And plus, you can't look at the ratios in isolation. For example, you might be preparing for a large buildup. For example, let me give you the example of this cement sector that we are using at the moment. In 2000s, there was a large level of construction activity going on in our neighboring country, Afghanistan. So a lot of cement was being exported from Pakistan to Afghanistan. There was a lot of demand. So what the companies were doing, they installed additional capacity. They were taking pre-orders. They were bookings. The prices were shooting through the roof. They were building inventory so that they can deliver on their promises, the orders, etc. If you would have looked at the ratios during that level, the current ratios would have been comparatively lower, largely due to the intensive buildup of the inventories. Okay, but that wasn't necessarily a bad thing. It was actually showing that the market is growing so rapidly and they are such good prospects for these key players that they'll end up having more profitability and more liquidity as well. So again, you can't look at the ratios in isolation. You have to see why the ratio is less. If the liquidity ratio of a company is less, is that because it's operating in a particular industry? What's the industry norm? What's the ratio of the key competitors? Then you also have to look at whether there have been any business justifications for the low ratio. What are the profitability ratio? What is the business plan? What is the level of the asset? What is the security that the business is offering? What is the past credit history? How is the banking history with your financial institution? And etc. etc. All these factors and several more are taken into account when the bank decides to sanction the finance for any corporation. I hope that answers your question, Hassan. Next, we have Hayan Heather. You are relating things superbly, but I'm not able to link subparts. Usually I stuck. How can I improve? Thank you, Hayan. There are two things. One is the core concept. You do have that. ACCA has equipped you brilliantly with the technical knowledge. The other thing is practical experience. Try doing that more. If you are not in a field where you can apply your knowledge more, then you can do that at your leisure time. Just take various financial statements, perform the analysis, go through the notes, try to go through the director's report, try to find out the information, try to start linking that. The more you'll do, the more used to you'll become with this, and you'll start getting at it better and better until you reach a level of excellence. Plus, if you need some help with that, feel free to shoot me an email anytime. I'll be more than happy to assist. Murtaza Bharatiya, when Spears includes in statutory reporting in quick assets ratio. Well, when we are creating financial statements for statutory purposes, we have to go through the definitions that are used for statutory reporting. The idea is that we cannot apply the luxury of being customizable. We can't change the ratios, or we can't report in the way that we like to do when we are dealing with statutory reporting. Why? Because there are standards, there are legislations, regulations governing that, and the regulators normally check these things. So if we do not comply, we would end up having an objection and redoing it anyway. So it's better to do it right the first time. And that is the very reason we have internal reporting mechanisms, so that management can customize the reporting ways, including the analysis, including the ratios, etc., and drive the meaningful information that the management requires. I hope that answers the question. Osama Mohammed Rashid. Ratio analysis provides a base for an apple-to-apple comparison. Are there any standards in place to govern their calculations, as difference in accounting standards worldwide still creates difference in companies reporting on GAAP versus IFRS? Osama, that's a brilliant question. I'm really proud of the level of our members. Yes, this is a major challenge, especially when you are in a field where you have to compare various businesses. This does become a major obstacle. However, the way this is handled is, especially when you are talking about internal reporting or using analysis for internal purposes, you are at liberty. What we normally do in practice, and it's normally done in many organizations and institutions, I know that for a fact, is you go through the standard that you are following. For example, you are this company. You want to see XYZ company, which is your major competitor, and you want to analyze how that is performing with relation to you. Now, this is an internal exercise you are doing for the purposes of your management. The question is the same, you said. You are possibly following some other standards and policies, and they are different. Maybe you are depreciating straight line on 10%, they are on reducing balance 25%, so on and so on. So what do? You take their financial statements and you put in a little bit of more hard work. You redo the financial statements using the same accounting policies as you. right? Now, that financial statement would be more comparable. And then you perform the rest of the analysis and you have a more meaningful analysis. That is what is being done at the moment. But the long-term solution is that the global accounting bodies have coordinated in an effort, and the accounting standards are constantly being revised and new standards are coming. And the idea is that over time, the subjectivity should be reduced as much as possible so that there can be a standardization. And if you look at the last couple of decades, there has been a huge move from subjectivity where were allowed to choose between various treatments to largely objectivity, where such choices have now largely been reduced to a huge extent. And I envision that in a few years' time, maybe a decade or maybe much earlier, uh, judging by the pace of it, you might end up with a protocol of gap where these differences would not exist or at least not be that material on a global extent. I hope that answers the question. Khwaja Kazim Latif. We say liquidity ratio above 1 or 2 is better, but is there any drawback to this? Khwaja Sahab, first of all, that's a rule of thumb. It's not always the case. It may be for some industries, it may not be for others. Now, the question whether there can be a drawback to it, yes, if you are too focused on liquidity and you are doing that at the expense of your trade potential, then there would be a drawback. For example, I'm a manager and my responsibility is liquidity, and you tell me you need to ensure that your liquidity is constantly above 2 or you'll not get your annual bonus. So what am I supposed to do? There would be a conflict of interest and ignoring everything else. If that is the sole point that I'm focusing on, I'll try to ensure that my liquidity is above 2 at all times. So what would I do? I'll start giving less credit to the debtors, right? My customers. What would happen if my competitors are offering the same qualities of services, products, etc., and are offering more credit? What would the customers do? Assuming everything else is equal, they'll start going to them. What would happen to me? My sales level would drop. Maybe my margins would drop. My liquidity would be very healthy. So that's just a proposition, just to give you an idea. So it's not always that a higher liquidity ratio is very healthy. As I said, you have to make connections. You do not have to look at ratios or analysis in isolation. You have to coordinate them with each other. You have to coordinate them with each other and make meaningful uh, information, make meaningful inferences from them to actually realize the information that you need. इसको थोड़ा सा आप नीचे की तरफ करते हैं या ऊपर की तरफ?
Yes.
So I hope that answers your question, Khwaja Sahab. And then we have Umair. Thank you for answering. That cleared my point. You are most welcome, Umair. Wajahat Umar Pirzada said, but related party transactions can also relate to trading. And then in that case, we should also take into account. Absolutely right, Wajahat. Even if it's with regard to the sales, you should adjust the sales for that level, because that sales, you have to see if it's a related party transaction. Was it like a genuine transaction, an arm's length transaction? And then even then, you should need to make necessary adjustment. Remember, if it's a related party transaction, you are actually threading a very tight rope. You have to actually look for the substance over the form. That should answer your question. Zahra Aziz, the example you have given, won't it end up in more current ratio as inventory is building up? Exactly, Zahra, and that was the point I'm making. If the inventory is building up, it might be that my current ratio might be higher, right? But the question is this, that okay, hang on. The example I made actually with regard to the inventory buildup was with regard to last year. I was actually analyzing this year's ratio, that why the inventory would be down. And one of the possibility is that maybe I built up the inventory last year, which I ate up in order to fulfill my increased demand, right? So my inventory buildup was in last year, and the last year's ratio would have been higher, as is the case in this particular financial statements that we are doing. it would not mean that my this year's ratio is higher, because this year the inventory is lesser. The buildup was last year. However, we also need to make connection, just like in this case when we investigated, the sales level actually decreased. So the question was, if the inventory buildup was for actually an increase in the sales level, then why the sales have not increased? And if the sales have not increased, where is my inventory going, right? One answer could be that the market prices in terms of the sales have decreased. But then I need to investigate. I need to find out from director's report, by speaking to management, from other information available at my disposal, to find a conclusive answer. I hope it answers your question. Then we have Ahmed Umar Fahad. When is the break? Okay.
It will be around 12:30.
Okay, we'll have a break. Let's take a quicker break at 12, and we'll come back at 15 minutes.
Yes, for 10 to 15.
Yeah, we'll come back at 12:15 and then we'll conclude. So we'll have to break in about 20 minutes for 15 minutes. Rizwan Hassan Khwaja, how can we compare companies with varying size relating to same industry? Rizwan, I answered that in my opening intro. Using the ratio analysis, we can do that. We'll also be looking at the horizontal and vertical analysis, which will clear this even more. Is there any indexing method that we can use? Yes, there is an indexing method too. Ahmed Umar Fahad. Seems like no one is responding to me. Ahmed, we did respond to you now. We actually had, mashallah, a lot of questions. So we have to go through them to reach yours. And also, Rizwan has asked, and also companies' performance compared to companies in other industry. I'm assuming you are asking how to compare a company's performance with companies in other industry. But my first question would be, why would you want to compare your performance with a company in another industry? You should be wanting to compare it with the competitor in your own industry. Can't hear you. I think this should have been sorted out and at your end. Amanat Ali Muralik, sir, are quick and acid test ratio same thing? Yes, they are the name of one and same thing. Ahmed Omar, thank you, Amanat Muralik. Why? Okay, so that's pretty much all. All the questions have been answered. Let's move quickly, and then we'll have our break after a couple of ratios. Next up is debt to worth ratio, which we have studied in our ACCS curriculum as debt to equity ratio. Extremely simple concept. You have your total debt divided by your total equity. The idea is this, that you are comparing the funding sources. You are comparing how much faith the business owners have in business. You are comparing the level of gearing. You are comparing the level of borrowing. Now, let's go back to the basics. What are the ways to raise finance for a business? You can either invest in the business, equity, or you can borrow, right? There can be different sources of equity. You can put in your money, you can get your friends and family as your partners. You can be a listed company where investors are coming in as the shareholders, etc., etc. Or with regard to borrowing, you can go to your bank for the overdraft, you can go for a long-term loan, you can borrow from a friend or family. If it's a company, even you can personally lend to the company. So there are different ways to raise funds with regards to equity or debt. Now, it's a very interesting concept. Let's revisit the concept. Debt is normally said to be a good thing. Why? Why is that a good thing? We also have another ACC in the room. Why is that a good thing with regard to funding?
That is regard to funding is good because the overall cost structure is minimized.
That is a cheaper source of finance.
Yes.
Why is that the cheaper source of finance? Two things. The main thing is that if your company does not have exorbitant level of debt, then you are not diluting your ownership. There is a set proportion depending on the market, 8%, 10%, 6%, 2%, 12%, etc. Secondly, there's tax saving on that. We all know that. Interest is a tax allowable expense. Dividend is not. Interest is paid from pre-tax profits and dividend from after-tax profits. I hope you all remember that concept. However, there is a dilemma. The same debt become expensive and a burden as the level of gearing increases. Why? Because as the level of debt increases in a company, an investor demands higher return because their risk level increases. And one of the fundamental concepts of finance is that risk and return are directly proportional. To make you understand this, just a very basic example, let's say you are sitting in a financial institution, two companies come to you with the same business plan, everything else same, just one difference. One company has 30% debt in their capital structure, the other 60%. Which one would you offer lower rate if you accept both? Obviously, the one with 30% gearing as compared to the one with 60%, right? Makes sense. Why? Because the investor is saying that before they pay me, they have to pay these people, all this money, and to back it up, they only have this much equity. So if the level of equity is higher, there is an increased confidence. But then again, a word of caution, you would even not look at in isolation on this ratio. You would still look at the industry practices, ratios of the competitors, business past history, their credit history, their business plan, their profitability, their liquidity, everything is taken into consideration. So while we have learned to analyze the ratios on a one-off basis, we also in practice need to learn to build their relationships, to look at ratios while connecting them with each other. Okay, so as I've shared with you, each industry has different debt to equity ratio benchmarks. Some industry tend to use more debt financing than other. Again, the example of the manufacturing sector, because that's capital intensive and machinery intensive, the level of debt in that industry is comparatively higher. A debt ratio of 0.5 would mean that there are half as many liabilities than there is equity. In other words, the assets of the company are funded 2-to-1 by investors to creditors, which would mean that investors own 2/3 of the company while the creditors own only 1/3 of the business. So, although the equity owners, the investors own the entire company, but in terms of the breakdown of the assets is what we are referring to. So, let's quickly run down some numbers. Debt to equity ratio, let's go to our financials. I hope you all have downloaded the PDF file by now. And quickly, can you all quickly compute the debt to equity ratio? I'm still opening the slide, so it will be more convenient for you all. Here you go. I'll give you all 1 minute 30 seconds for this. Time starts now. All the best. Ijazul Haq said, I thought debt to equity is total debt by total equity and not total liabilities by total equity. Ijaz, these are interchangeable terms with regard to British and American English. So what you are seeing here as total liabilities is the total debt. That is basically a term for liabilities. Oh, we have the first answer. Fatma is a winner. But Fatma, please mention the year. And you need to compute it for both years. Okay, I think the time's up. And we have the ratios coming in. 2.7, 2015, 0.19, 2015, 8%, 5%, Hayan Heather 1.94, Zara Aziz 1.19 for current year 15, Hayan 1.91 for 2014, Bilal Hadayat has calculated, not very confident. After Burkhardt 5.1 and 7.6. Why is there so much difference? Umesh Sheikh 19% for both years. Okay, let's quickly do a basic calculation and find out what should be the answer. Okay, we first need to calculate the total debt level. So, what would be my total debt? Any guesses? Now, there are different ways to do this. Obviously, I'll take all of my non-current liabilities. With regard to the current liabilities, some people argue that trade and other payables should be taken off and only accrued finance cost and short-term borrowings can be taken in. Anyway, if you are doing the internal analysis, you are open to take the various variation. Here, for illustrative purposes, we will take the total figures of both 6583476. So this is my level of total debt in the company. Then I divide it by the level of equity that I have in my company, and I have this ratio of 0.19. Now, what would have been another variation? Another variation could have been that I take all of my non-current liabilities, which are my long-term debt, and then I take the borrowings, the accrued finance cost 27,304, the secured short-term borrowings 1826072, current portion of non-current liabilities 646931. This is basically simply the debt that is repayable within 1 year, and then the provision for taxation I need to pay in 1 year. So I've just taken out the trade and other payables, and this is the level of the cost we have. So basically what I've done is I've simply taken out the trade and other payables from here and then added up the non-current liabilities. So let's compute the ratio. Since this is the total debt, I now need to divide it by total liabilities, total equity. And here we have the total equity. And here we are. So do you see the difference it can make of using a variation? From 0.19, it has dropped to 0.12. Now, let's assume that there was a difference from last year, which there obviously was. So how would I analyze? How would I try to find out what the difference was due to? First of all, was there any difference in the equity level? Yes, the equity has increased slightly. How? My issued, subscribed, paid up capital remains the same. My reserves, other reserves have increased a bit, decreased a bit. Interesting. Was there a devaluation? Let's find out. And my accumulated profits have increased, which is not surprising. My profit from last year was the accumulated retained earnings from last year went to the accumulated profit reserve, and certainly the same happened this year. So that makes perfect sense. But this is something that is intriguing me, and I need to find out why my other reserves drop. It's note number 6. So let's find out. Okay, here are the movements in and composition of the reserves. My share premium reserve remained the same. Fair value reserve at the beginning of the year was this. Then there was a loss in the fair value. And this is what it is at the end of the year. And then there is a capital redemption reserve which remained the same. So the major differences in the revaluation reserve, there has been a loss. And if I go to 6.2, as referred to in note 4.8, this represents the unrealized gain on repayment investment at fair value and is not available for distribution. So while revaluing my investments, the company's investments, I have recorded a loss of this much. And that is the prime reason why there has been a material decrease in my reserves. But despite the decrease owing to the devaluation, my accumulated profits retained for the years have been more than sufficient to compensate that decrease. And in fact, the net result has been a slight increase. Now let's look at the liabilities part. My non-current liabilities, long-term finance has increased. Again, I'll go in the note, I'll see why there has been increase. Certainly, I have secured a long-term loan. Then I'll see why I have secured that long-term loan. Is it that I was just facing financing difficulties, repaying my loan, or is there a major business project? Maybe I'm building additional capacity, I'm installing new machinery, and I have financed that in terms of a loan. Then my long-term deposits have increased. I'll need to have a look on that. Retirements and other benefits have decreased. Why? Has my staff level gone down? Or has there been a lot of retirees as compared to new staff? Because there is a substantial decrease, I need to investigate the reason for that. Again, I'll go into note 9 and study that. Then the deferred taxation has slightly increased, which makes sense. My trade and other payables, they have substantially increased. Just like the other areas, I need to find out why this happened. In fact, let's quickly have a look at note number 11. These are my trade and other creditors. My trade creditors have doubled. These are related party transactions as we previously find out, and the rest is pretty much the same. We have already seen that. So let's quickly move. Now you have an idea how to investigate. Ratios are just the beginning. You compare them, drive the information, then you further analyze why these things happen, which figures change, what was the change for, was it controllable, non-controllable, how is it impacting the other areas of the business, how this is fitting in the larger picture and larger scheme of things. So let's go back. We are done with the debt to worth ratio or debt to equity ratio. This brings us to the gross profit margin and net profit margin ratios, which are extremely simple, and you are aware how to compute that. As promised, I think let's quickly take a break for sharp 15 minutes. It's almost 12 o'clock, and we should all come back and meet at 12:15. Please get fresh, take a tea break, whatever you want to. We'll meet back at 12:15 and we'll run down through the rest of the presentation and the contents that we have to cover. And we'll also start by having any questions that you have. So please write them down and I'll see you in 15 minutes. Thank you. So I mute this. Assalamu alaikum. Hello and welcome back to all of you. I hope you are all feeling fresh now after the break. Let's continue from where we left. First of all, if you have any questions, you have 1 minute to please type them, and I'll be more than happy to answer to them. Okay, we already have a few questions, so I'll start answering them. Okay. Muhammad Ahmad Kamal Khan, shouldn't total equity also include share capital? Yes, Kamal, it does, but which share capital? The issued, subscribed, and paid share capital, not the total limit, but the one that is actually issued, subscribed, and paid. Muhammad Awais Khan, should we not be using issued capital only, as reserves may also include revaluation surpluses and impairment losses, etc.? No, because reserves, including the retained earnings or accumulated profits, are part of your equity. So basically what we are taking is not shareholders' capital, but the entire equity. Ijazul Haq. At this point, when we look at a decrease in revaluation of investments, will the financial analyst not question the management that investment was made, which resulted in revaluation decrease? A big question. Good question, Ijaz. Certainly, you can ask the management why there was a devaluation. But remember, hindsight is a blessing. For example, if you remember, almost a couple of years back, there were changes in property taxation laws. Until then, the property market was flourishing like anything. Every day, the prices were skyrocketing. And as soon as those changes came into effect, which a normal businessman couldn't have foreseen, the property market became stagnant and going down and down and down. So if somebody would have made an investment then, they would certainly have recorded losses in the valuation later on, though not fault of their own. So when you ask the management and investigate, you would have to see whether the investment was made through proper analysis and in line with the business goals and objectives. If yes, then that's fine, because you cannot control all the market factors all the time. So you'll need to still be very careful while making these judgments and analysis. Afzal asked, I could not hear you. Is there a problem? I think, Afzal, you joined late. We went for a break. Khwaja Muhammad, is debt to total assets a useful ratio, or is it used by companies only? It is a useful ratio, and it is also used by companies. Musin Ikram, hi, there is some problem with the audio. I've checked the audio setting on my computer and it is. No, Mohsen, there is no problem. We were on a break and we are fine. Faisal Manzoor, let's go. Yeah, we are. Sarah Aziz, how do we differentiate between gearing ratio and debt to equity ratio? How we interpret both differently? Good question, Zara. We'll be covering that. So any other questions right now about what we have covered to date? Covered till now, actually. If you have any questions, please feel free to ask. Okay, I'll give you 30 seconds more. If none, then I'll assume that there are no questions because I taught you so well, and then we'll move on. Okay, so apparently we have no questions. Great, let's move forward. Gross profit margin is also referred to as gross margin ratio, and we similarly have net profit margin referred to as net margin ratio. These are profitability ratios where we are also measuring that how efficiently a business is using its direct materials and direct labor costs to produce and sell products and services profitably. So the formula for gross profit, we all know sales minus cost of goods sold, gross profit percentage, gross profit margin, gross profit margin ratio. The formula is gross profit divided by total sales. Net profit margin, net income by total sales, and here it's slightly different to gross profit margin in that we are computing how effectively a company can convert its sales into net income. Obviously, creditors would like to make sure that a business has sufficient profits to pay back the loans and finance costs as and when it's due, and that the business is running efficiently. An extremely low profit margin would indicate that the expenses are too high and the management needs to budget and cut their expenses. So now let's go back here and perform some ratio calculation on profit and loss account. Here it's page number 104 on your PDF file, and I would like you to compute your gross profit margin for both years. Extremely simple. Here are your gross profit, here is your sale. Go ahead. Ajaz has computed 36.22, and when you are computing, please mention the year that you have computed the ratio for, whether it's the current year or the prior year. So 36.22% for this current year and 34.87% for last year. So there has been a slight decrease, and we can see that's largely owing to the decrease in the sales. And we need to go through the notes, see why there was a decrease, ask the management, etc. Now, net profit margin, take your profit after taxation, 762,460. Divided by your sales, straightforward, and to 100%, 29.21% approximately. And then for last year, so we can see that there has been a decrease in the gross profit margin, a decrease in the sales, but an increase in the net profit margin. Interesting. So now we would need to see why there is an increase. There is a slight decrease in admin expenses. We'll find out why. There has been a huge decrease, almost 50%, in the selling and distribution expenses. There has been slight increase in other operating expenses. Other income has increased materially. So two things which should immediately focus your attention are the massive decrease in the selling and distribution expenses and the material increase in the other income. Similarly, finance cost has substantially decreased. This we already discussed. That was a result of the repayment of the loans. The taxation has slightly increased, which was natural considering the increase in the level of profits. So two things I would like to investigate immediately right now, although you should investigate all these factors, they are important, is note number 30 and note number 32. So let's quickly do that. Okay, here's the note number 32, my other income. How did it increase? Income on bank deposit increased a lot, and then markup on loan to related parties decreased. Unrealized gain on derivative financial instrument. This I would like to find out more about from the management. What was this derivative financial instrument on? What is the unrealized gain that you have recorded? Then gain on disposal of available for sale investments, which is fine. I've earned from investments. Gain on investment at fair value through profit and loss. Okay. Dividend income has slightly increased from related parties, and from others it has increased a lot. Then my rental income is largely the same. Gain on disposal of property is lesser than last year. Scrap sales have increased, and that's the overall difference. The major increase has been gain on investment through fair value. I need to find this out, why this was there, and which investments have been revalued upwards. I need to also check the income on bank deposit, and I need to find out more information about unrealized gain on derivative financial instruments. So I can see that these revaluation does not necessarily have to do with management's ability to predict. It might be, but I can only find that out once I've gotten the relevant information. Then I can decide whether it was a result of calculated management decision or just a stroke of luck due to the market factors. Now, my selling and distribution expenses, which have halved, and I can immediately see that one figure stands out, the freight and handling charges, which has reduced by more than half, almost 60% plus. So why my freight and handling charges have decreased? Have I started my own division, or have I shifted a focus from export to local markets? I'll need to find that out by discussing with the management. So now you see how you get to know the actual reason behind that, and maybe the management would tell me it's because we are focusing more on the local markets now, and this is our vision, and then I can correlate that with the entire information that I've been getting from the ratio analysis. So this brings us back to our presentation. We have done gross net profit margin. These are income statement or profit and loss account ratios. These are also the profitability ratio, and also give us an indication of the efficiency. But if we talk about efficiency, there are certain ratios which gives us a more clear idea, starting with return on assets ratio, extremely clear concept. Net income divided by average total asset. Average total asset, we know how to compute. You take the closing assets for this year and the opening asset divide by 2. If you do not have the figure for the opening assets for this year, last year's closing assets are this year's opening assets. So return on total assets or return on assets ratio is often called to as is often referred to as the return on total assets ratio. It's a profitability ratio that measures the net income produced by using the total assets during a period, and can be represented as a product of net profit margin and sales to asset ratio. Net profit margin, net income divided by sales, sales to total asset ratio, sales divided by total assets, sales cancel, net formula is net income by average total assets. That's how these ratios are also correlated. So if you want to break down the return on total assets ratio, then you can look at the net profit margin and sales to asset ratio and see the link and relation with them, and drive the impact on return on total assets ratio. This ratio measures how effectively a company can earn a return on its investments in assets. So let's quickly do this ratio as well, return on total assets. Here, for the first time in our session today, you are using a ratio which drives one part of its figure from income statement and the other from the balance sheet. So here you go. You have the PDF files with you. Go ahead now. Net income divided by average total assets. Remember to compute the average total assets. You'll only be able to compute this ratio for 2015 because you need to compute the average total assets. In practice, if you don't have the average total asset, you just take the total assets as an approximation. So net income 7,624,680 divided by average total assets. Total assets for this year 743,91,443 plus last year's divided by 2. Please compute. What's your answer? Put it in the questions box. Do not send it through any email. You have 30 seconds. Shouldn't take that long. Khyam is saying I can compute quicker than them. Tell him that you are quicker than him. And they are about to tell you. See, we have got first answer. Ejaz 10.32.
This is within 30 seconds.
Yeah, see, that is called motivation. Okay, let's see whether Ejaz was correct. I am assuming Ejaz was correct. Let's find out. 7624680 divided by average total assets. So we need to use 74391,443 plus 73282,069 divide. Now that ended up being wrong. Let's redo it. I'm so used to my calculator. This is your average total assets. 1 by X will take it down, and then you now need to incorporate net profit for the year. And Ejaz was correct, as we suspected. Well done, Ejaz. Good. Okay, most of the people have calculated it right. What happened to you, Zara? Normally you are very prompt and right, but yes, we are all humans. So now I need to see why this ratio is this. I can see one thing, that my assets have increased from the last year, and the increase has largely been due to an increase in my fixed assets. And I can see the major increase there is in investments. So I'll go in note 19 and investigate why there were these investments. Then similarly, I already have investigated the reasons for my increase in the net profit, and together these things will show me why my ratio has come to this level, and whether that was thanks to the efficiency of management or by market segment and market factors. Mistakenly, Lara, I took sales figure. Happens. Never mind. Okay, let's move forward. Return on invested capital is slightly different concept. What we did previously was we took net income and divided it by average total assets. Remember, your assets are what? Capital plus liabilities. That's how your assets are funded, right? Now what we are doing, we are taking out dividends income. We are making it more comparable. And then we are dividing it by total capital invested. Why we are taking out dividend income? Total capital invested involves your debt, and the cost of debt, which is your interest expense, the finance cost, is already taken out from net income. So it's only logical if you want to compare like with like, and you are adding equity in the total capital invested, then you should also take out the cost of the equity capital, which is effectively your dividend. Then this becomes more comparable. Return on invested capital basically measures the performance of the management of a business by looking at how it uses the money provided by shareholders and bondholders to invest in the business to generate the revenues. Again, because we have limited time, I wish we could calculate all these ratios using these financial statements, but I guess we'll have to skip some of these because we want to finish this off within the available time. However, you have these financial statements with you and the presentation. Do the computation. If you feel there's any confusion or want to ask any question, even later on, I'll be sharing my contact details at the end. And if you already downloaded the presentation, they are at the end. Feel free to contact me. I'll try to get back to you as quickly as possible. The best way is to either send me an email or send me a message on WhatsApp. The first time you do, please include your contact details and an intro, especially if you are sending through an email that you attended this session and the question is in relation to this. Next, sales to asset ratio It's also referred to as asset turnover ratio. Extremely simple, net sales by average total assets. Basically another of the efficiency ratio that measures how efficiently a firm is able to use its assets to generate sales. And obviously the higher the ratio, the more favorable it is. It shows whether or not the company is overspending by buying too much inventory and wasting resources by storing non-saleable inventory. It also depicts whether the company can effectively sell the inventory it buys. Let's quickly compute this. Cost of sales divided by average inventory. Oh, what happened? We went to the next. Sorry, net sales divided by average total assets. I was wondering, why is there a reference to the inventory here? Anyway, it happens. Sorry about that, guys. Higher turnover ratio means the company is using assets more efficiently. Lower ratio means the company isn't using the assets efficiently, and the management or the production have stuck some snacks which needs to be removed. So let's compute the asset turnover ratio, net sales by average total assets. You already computed average total assets, and here is the figure for net sales. So go ahead and compute. You have 1 minute to compute the figure, and you just need to compute it for 2015. Go ahead. Time starts now. These were your average total assets, which you computed. So 35.35. And let's see what our respected members got. 0.353, Hayan Heather. Well done. Yeah, you multiply it by 100% and you get the same answer. Well done, Hayan, the first one to answer. And I think that clarifies the concept. Let's move back to the presentation. Before we go on to the next one, if you have any questions on what we covered to this point, please feel free to ask. Okay, we got answers from Ahmad Omar and Faisal Manzoor, which are also right. Well done, guys. And let me answer your questions that are already there. Meanwhile, if you have any other questions, please write them. So there's a question from Muhammad Adnan Salah. These ratios are for companies, right? What you will offer to individual investors? Well, this financial statement is of a company. These ratios can be used internally or from the investor perspective as well. From the investor perspective, we'll be looking at how good this company is as an investment, whether it's offering the return that we require, the result that we get. We'll then compare that with the investor's IRR, or we'll incorporate those results and figures within the NPV calculation and find out whether it's an attractive proposition or not. Similarly, we will also compare this with the other investment options available with the investor. Amanat Ali Malik, what is the purpose of debt to equity ratio? To measure the level of debt in the company, to see how much equity financing is available in the company, whether there is too excessive debt or there is an appropriate level of debt, whether the risk is too high or it is within our acceptable limits. From the company's perspective, we'll be looking at the same things from their internal perspective, whether we are taking on too much debt or too less debt, whether we can take more debt or we should stop taking more debt. All these questions. Muhammad Adnan Salah, if you are in that industry and wants to expand this service to individual investors, how do you convince them for using this analysis? May this question might be off the topic, but please do respond if you can. Of course, Adnan, if you are in the advisory services, then most of the clients that would approach would already know the value of this. When they are investing, they are making a big commitment. They are investing their hard-earned money. They are investing their inheritances, their funds. They are normally spending huge amounts in terms of the investments they are making. And it's only in their best interest that they hire a professional to make these informed decisions on their behalf so that they can be sure that they are making the right investment in terms of their investment objectives. Again, this is just a part of the investment process. When you are managing a portfolio, you have to start with an investment policy statement, IPS. However, that is not the subject of today, and I hope this answers your question. And next, Ijazul Haq, does selling distribution expenses decrease has to do something with the current asset stock of packaging material, which also get reduced during the current year? Yes, Ijaz, very much possible, and that's why we need to go through the director's report, speak with the management, and find out more in order to make an informed decision. Sara Aziz, why do segregates sale from net sales apart from discount? Okay, net sales mean you take off any returns, sales returns. In our company's case, there were no sales return. Otherwise, wherever you are computing a ratio and using sales figure, you normally use the net sales figure, which is sales minus net sales. Why we take the net sales figure? Because any returns that you have gotten back is not your income or revenue.
Do you want?
Okay, I hope that answers your question, Zara. If there are any other questions, please feel free to ask. Otherwise, I'll just move on. By the way, I also have a few questions for you. So you have no questions, which means we have been doing it really well. So let me ask my questions. Oh, Asif asked a question. I'll answer that and then our questions. In fact, now there's another question by Dania. So Asif is saying few companies use closing assets while others use average assets. This often causes difference in ratios. Doesn't it the way to manipulate? It's not really manipulation, Asif. As long as you have a certain purpose, you'll be computing it as per that way. So as an analyst, someone analyzing, what we can do is we can compute both companies' ratio in a similar manner. Either use the average assets or use the closing asset. Then they would be in the similar manner and we'll be able to judge their results. Dania Awas, please tell how do you calculate average total assets? Dania, opening assets plus closing assets divided by 2. Okay, now that's done. So now it's my turn to ask the questions. Are you ready? After I'll answer your question now after you answer mine. Here is the question.
You have to minimize the presentation.
Minimize the presentation first.
Yes. It's
Okay. Here's the question. So, first question, just omit it. I'm not gonna ask you that easy a question because you all know the answer is balance sheet. It depicts the financial performance at a point of time, and income statement, the balance sheet, the financial position at a point of time, and income statement, the financial performance for a period of time. Now, first question, which of the following would be categorized as a liquidity ratio? Net profit margin, gross profit margin, asset turnover ratio, current ratio. And if any of you gets this wrong, I'm not gonna spare you. Perfect. All the right answers. Well done, Ali Sheikh, Awais Khan, Umar Pirzada, Umar Sheikh, Faisal, no Faisal, asset turnover. If you have to choose one, then it will be current ratio. But very good to rest of you. Now, next question, I'll ask you later because we haven't touched that right now. But be ready for that. Well done. Let's go back to our presentation. Okay. Before moving on, as I promised, I'll quickly answer the questions you asked in the end. Aftab Barkat Ali asked, net sales also excludes scrap sales or any other sales not part of the business. Now it depends. If you are doing an internal analysis focusing on your prime business, then certainly you'll exclude the scrap sales and net sales. If you are looking at the overall net profit margin from a regulatory perspective to be included within the ratios in your consolidated financial statements in your annual report, then you'll add that because you are looking at the overall net income. So it depends the purpose you are using the ratio analysis for and whether you are an outsider analyzing or you are a company employee analyzing, whether you are analyzing it to be included in the statutory annual report or for some customized purpose. So depending on that, you'll decide. Okay, any other question or we shall continue? 30 seconds because when I normally continue, a question comes. 30 seconds is sufficient time, right?
Yeah, almost.
Almost sufficient.
Because they were writing, maybe some people are writing longer question. So I think that will take some time.
Okay. You remember your student days. Sympathies. Khwaja Mohammed. To ensure consistency, are there standards formula defined by any authority for ratio analysis? Khwaja Sahab, there are some ratios which are defined, for example, EPS, there's a particular way to compute it. For others, there's no definitive formula and you have some subjectivity at your disposal. But there are industry best practices which normally the industry participants follow. Noman agrees, can we use closing inventory instead of average inventory? Yes, you can, Noman, especially if you don't have the last year's financial statements available. So I guess that's it. All the questions have been answered. Let's move forward. So we just did asset turnover ratio, and this brings us to a series of turnover ratios, beginning with inventory turnover ratio. Again, the concept is very similar. We are just measuring how efficiently we convert our inventory, our average inventory, whether we are overspending, building too much inventory, or we are not building sufficient inventory, or we are doing it rightly. So the formula of average inventory turnover is COGS, cost of goods sold, divided by, again, average inventory. In this formula, ideally, you shouldn't use closing inventory. You should always use average inventory. Let's quickly do this. Cost of goods sold, you have the figure here. Again, you'll have 1 minute to compute. I hope all of you would have noted down the cost of sales figure. You also have this PDF file at your disposal. Then you have to take average inventory. Now the question is, what should I take? Store spare and stock in trade or just stock in trade? Yes, Khayan.
I think just stock in trade.
Why do you think that?
Stores.
But let me tell you, you think right.
And loose tools are not in, like, they are used for their.
Exactly, they are just there for the sport purposes. They are not part of your inventory. You are not selling them on the day-to-day basis. It's your stock in trade, the inventory, that's the relevant figure. So you'll add these two figures and divide them by 2, and then you'll have the average inventory figure, and you'll compute your ratio. And I think we have about 20 seconds left, and we already have answers. Fantastic. Come on, guys. If some of you can do it, then the rest of you can do it. Come on, quick. You still have 30 seconds. Okay, and 20 seconds. And 15. And 10. And 5. And time's up. Oh, we have got so many different answers. The majority have answered 13.12, but we also got 7.61, 13, and we simply got 2015. No, he just mentioned it. He gave his answer separately. So mostly it's 13.12. I think it would be that, but let's quickly do a check to ensure that our respected participants got it right. 1188376 to plus 1348742 divided by 2, average inventory, 1 by x would take it downwards, denominator, and for numerator, we have our COGS 16649,411, so it's 13.12. So whoever computed that, well done. Now, the question could be, if let's assume the last year's ratio was 13 or 14, we'll see why it changed this year. So we'll see the cost of sales. The cost of sales decreased. So I'll go in note 28. I'll see why it decreased. I'll see the reason. Then I'll discuss that with the management, or I'll read the management report. Similarly, I can see that my stock in trade also decreased. So I'll go in note 22 and find out why the stock in trade decreased. Have I changed my market focus, market segmentation, or was I building stock in the last year that I used? If I was, then why didn't my sale increase? Did the price of the sale decrease? My market price of my product decrease? That's why, although my volume increased, but my sales as a whole did not increase due to a major decrease in the price. All these things would need to be investigated, and I'll find out the answer to them and decide the end result. So now that we are done with inventory turnover ratio, your most favorite, I hope you remember it, the average days or days sales in inventory or inventory turnover in days. There are two formulas. Either you can simply divide 365 days by average inventory turnover ratio, which in this case was, I think, 13.12, right? Yeah, 13.12. So 365 divided by 13.12. So our company is taking 27.82 days to turn over its inventory. The other longer route formula would be ending inventory divided by cost of goods sold into 365 days. Let's find out if the end result is the same. The ending inventory is 1188376 divided by 16649, the cost of goods sold, into 365 days. Almost same. There are rounding errors, obviously. That's why there's a slight difference, but otherwise the result would be same. If you don't do any rounding when you are computing the inventory turnover ratio, then the end result would exactly be the same. So you can do it either way. If you already have computed the inventory turnover ratio, you can use the short formula. Otherwise, you can go through the long formula. It simply measures the number of days it will take the company to sell all of its inventory. It also shows on average how many days the current stock of inventory will last. Now, the similar concept with regards to the account receivable turnover ratio, it measures how many times a business can collect its average account receivable during the year. We take our net credit sales, divide them by the average account receivable. It's the same concept. In inventory turnover, we take the cost of goods sold divided by average inventory. In account receivable, the account receivable are derived from credit sales. So we take net credit sales and we divide them by average account receivable. Inventory turnover, average inventory is related to cost of goods sold. So cost of goods sold is divided by average inventory. In average account receivable turnover ratio, net credit sales is divided by average account receivable. It helps us to focus and assess our credit collection policies, whether we are collecting our credit efficiently, and our management of debtors is in accordance with the company's credit policy. You can compute that on your own. Similarly, the average collection period, it's similar to the average average inventory days ratio. You simply divide the average account receivable by credit sales and multiply that by 365 days. Or if you want to do it the other way, if you have already computed the average account, the account receivable turnover ratio, simply divide 365 days by account receivable turnover ratio. I would like you to use this formula for the average collection period and quickly compute the average collection period. So what you need is average account receivable and credit sales. Your average account receivable would be in your current assets. Here are your trade debts, your average account receivable. Go ahead, add these two and divide them by 2. Now you'll need credit sales. Where would you get credit sales from? Here you only have the sales figure. You'll need to go in note 27. Okay, we are not given a bifurcation of the credit sales. So what we'll need to do is we'll need to contact the management to ask them about the bifurcation of the credit sales in this case. So for right now, just for illustration purposes to compute, I suggest you just use the total sales figure and just come up with the answer. In practice, what we'll do is we'll actually go to the management, we'll read the director's report, and we'll find out the bifurcation that how much of the sales are actually the credit sales. If we go through the policies and director's report, even right now, I'm sure we'll find out the hint, 30% of the sales are on credit, etc., and we can work out the credit sales figure. But due to the limitation of the session, we are in the last 1 hour, I suggest that just use the sales figure for illustrative purposes. So has anyone computed it? If you have, please share your answers. Okay, Avas has come up with 160. I'm assuming that's correct considering the sales figure is so high and the average data is minimal. And this is very typical of this industry. Why is that? Because in the cement sector, normally the payment is made either in advance or at delivery. There's hardly any concept of credit. So maybe there were some intra-party credits that were made. Other than that, there's minimal credit. So 160 means that you are able to collect. Have you used the correct formula? Let me just quickly do it anyway to ensure. I'm hoping you did calculate the average account receivable. Stop and trade. 156,899 plus 168,769 divided by 2, and we assumed that we'll take the actual sales figure for illustrative purposes to be the credit sales. So we'll divide it by 126,104,611, and then we multiply it by 365. So it's 2.27 days. Exactly. How could you come up with 160 days? It's simply not possible. Must be an error. Okay, 26.7 days, Murtaza. I think you got a computation error. Aftab Barkat Ali, 2.2 days. Exactly. Perfect. Well done, Aftab. So what does this show us? That the average collection period for whatever credit the debtors we are having is just 2.2 days. Fantastic. It's quite in line with the cement industry, actually. Again, this can be computed in multiple manners. I've given you the 2 most common formulas that are used. Similarly, we have the ratios for account payable turnover ratio, where we use total purchases divided by average accounts payable. It's also a liquidity and efficiency ratio, which shows us the company's ability to pay off its accounts payables or trade creditors. In other words, the account payable turnover ratio shows how many times a company can turn over or pay off the balance of average accounts payable during the course of the year. It helps creditors analyze the liquidity of a company by gauging how easily a company can pay off its current suppliers and vendors. The higher the ratio, it shows the suppliers and creditors that the company pays its bills very frequently and regularly. I would like you to compute this for the current year. The average, take the average accounts payable, again, the opening closing account payable divided by 2. Take the total purchases figure and you'll have the accounts payable turnover ratio. Take the relevant figure from here. I hope you have taken. Then now you have to take the average account payable. Do we have any average account payable? Yes, we have trade and other payables. Just take these figures for illustrative purposes. Practically what you'll do is you'll go in note 11. In fact, let's do that in fact. Why not? Note 11. Let me show you how it's done properly. Now these are your actual trade creditors. Okay, so you need to take these figures, take the average of them, what do I do now? Total purchases. Where will I get total purchases? Obviously, we all know income statement. Now, I have a cost of sales figure here. For total purchases, I should go into note 28. Here's the note 28, and I'm looking for my total purchases, and I can see the raw material and packing consumed, and my purchases, opening, work in process, closing, manufactured, salary, wages. Okay, I'm not given a bifurcation of purchases here. So I'm going to take this raw and packing material consumed figure to be illustrative of total purchases. In practice, what I'll do is I'll go through the notes, I'll read the director's report. If there's no separate purchases figure, then I'll need to consult with the management and ask them what is the purchases figure. Let's assume this was actually the entire purchases figure. And then I'll come up with 3.84. What does this ratio mean? It means that this company is able to pay its average account receivable balance 3.84 times during a year. Okay, very well. But how long does it take in days to pay the suppliers, the average suppliers? Again, the same way we computed it for our debtors and for our stock, we can compute it for our payables as well. Take the average accounts payable balance divided by credit purchases and multiply it by 365 days, and you'll have the answer. Now, we have the same challenge that we don't have the credit purchases figure here. So we'll have to assume that the purchases figure is the credit purchases figure here. And we'll simply take the average accounts payable balance and multiply it by 365. So let's do it. Let's take this to be the credit purchases figure 2231. In fact, why am I doing all the computation? Compute it quickly. You know the figures, you have the file, you have the formula, do it quickly. Average accounts payable, credit purchases. Credit purchases 2231919. Average accounts payable, go back to the balance sheet. Here you have the average accounts payable. Go to note 11. Take the average of these two and come up with the answer. I'm giving you all 1 minute. And once you have the answer, multiply it by 365 days to convert it in days. Average accounts payable divided by credit purchases into 365 days. Quick. 95.17 days. So, did you get the same? Did I make any calculation error? I might be testing you. Don't just follow me. The answer could be different. Okay, we are getting some answers. The time is up. If you have made your calculation, please share your answer now or we'll have to move on. So, the first correct answer is by Mushtaba Bashir. Well done, Mushtaba. Good work. So the answer is 95. This means that we are taking on average 95 days to pay our creditors. We'll have to look at our credit policy. It may be that the creditors have allowed us up to 100 days, then fantastic. If they have allowed us 60 days and we are taking 95 days, we have to see what could be the implications on our trade as a whole, because it's not just that you are taking the credit and well done, you have taken 95 instead of 60 days. If the creditor get annoyed and stop my supply and my supply chain is threatened. So all these things need to be taken together and considered. So we have concluded ratio analysis. Largely, you have seen that ratio becomes more meaningful when compared with other benchmark. What could be the benchmark? The industry average, the competitors, your own previous years, and forecasts. An analysis of ratios over time is referred to as the trend analysis and is useful in establishing positive or negative trends. There are some limitations of ratio analysis, although it's a fantastic tool and very important, but you need to be wary of these limitations. First of all, I've shared with you that picking an industry benchmark can be challenging. It can be. And I've given you a solution, especially considering Pakistan or India or Bangladesh, this region, how you can, and even in Middle East, how you can come up with industry benchmark by putting in some effort, going through the data of 10, 20 large players in that segment and using that data as an approximation for the industry benchmark in the absence of any industry benchmark. Published peer-to-peer group or industry averages are not always representative of the firm being analyzed. Normally, these averages are published by the chamber or bodies or association of larger players, and some of the smaller players are not included in them. So they are actually skewed upwards and may not be appropriate or representative of smaller players. You need to keep that in mind and adjust for that. An industry average is not necessarily a desirable target or no. It may be that there are only 4 or 5 good players in the industry and the rest are just surviving. So you should ideally be aiming for the top, not the average, which in such an industry would be skewed downwards. Accounting practices vary differently. They differ widely among firms. We have discussed this point and we have also discussed the solution for this. Many firms experience seasonal change in their operations, so you need to be careful if you are using only periodic data, not an entire period annual data which is covering the entire seasonal window for a business. Financial ratios offers only clues, which I've been stressing throughout, and you have seen. We need to analyze these numbers and investigate the changes in order to fully understand the ratios and make informed decisions. The result of financial analysis are dependent on the quality of financial information, garbage in, garbage out. Now, before we move on to the horizontal and vertical analysis, if you have any questions about what we have covered till now, please feel free to ask them. I have some questions which I'll start answering. Meanwhile, you have the time to type the question and ask any questions that you may have. Okay, I have one question, which is by Mohsin Ikram Saab. How is average accounts receivable calculated? Mohsin, opening account receivable plus closing account receivable divided by 2. After Barkat has said cost of sales question mark. What are you asking? You're not asking what cost of sales is? Can you elaborate your question, Aftab, and I'll be happy to answer. Fahad, sir, when will you start vertical analysis and horizontal analysis? Right after this, Fahad. Any other questions? Because if you don't have any questions, then I'll have some questions. Very quick. Okay, I'll give you 1 minute to ask any questions. You know what? I'm in a very, very generous mood. I'll even allow you to ask questions there, if you have it.
Right now, I don't have any question, but I have a comment over the question of like Aftab. Lots of people have been sending questions like this. Aftab have sent us. I have time and again requested them to kindly at least send those questions which can make sense.
No, it's okay. You know what? I always believe that because we are taking everyone along, so it's fine. No question is a stupid question. In fact, I encourage the questions. It may be that a person is totally cut off from implementing this knowledge in practice or are in early days. So this would serve as a reminder. And ACCA wants to contribute and strengthen its members base and their knowledge. So it's fine. I don't mind these questions.
But at least for clarity and understanding, I think the question should make sense.
Write them coherently, write them fully what you want to understand, so your question can be answered. Okay, and we have another one by Faisal Mansoor. Can we use the ratios for forecasting the financial performance? Absolutely, that's what we do in trend analysis. We establish the trends, it's going up or downward. That's what we do in technical analysis or charting. If you are related to investment, or if any of your friend is, that is one of the important tools used in the investment, especially in the investment banking industry, amongst other tools. So yes, to answer, it can be used as well. So I think that's pretty much it. It's my time to ask questions. This time it's open.
All tab. We don't have.
No, I just clicked and it's open. So why did I have to minimize the presentation last time? Okay. I think because we haven't enabled editing that time.
Yes.
Okay, guys, your next question is question number 3. List 4 possible benchmarks to be used in ratio analysis, and we just covered that 1 slide ago. So you better be able to answer that. And we have the answers already coming in. Fantastic. Wajahat Umar Pirzada, industry, not industry, Wajahat, industry average, competitors, forecasts, and previous years. Good. Muzammil Khan, industry average, past year. Hassan Raza, industry budget, holisty, I think mean historic. Fatima Askur, competitors, Sanaullah competitor, Dania West last year, Umesh Sheikh, industry benchmark, regional benchmark. Original too, yes, you can use that. Peer benchmark, previous year figures. Now, good, good, good. Well done, well done, well done. I got an idea. They have been paying attention, which is good. Okay, yes, you can use all of them as industry benchmark, as your benchmark, the industry averages, the competitors' figures, the previous year's figures, and the forecasts. Fantastic. Now let's move on to the horizontal and vertical analysis. If you remember the graphs, we have the x-axis and the y-axis. X-axis is what? Horizontal or vertical? It's horizontal. And the y-axis is vertical. Do remember this concept because it will help you understand this that we are about to discuss. Some people find it challenging, but I'll tell you it's extremely simple if you take the concept with you. The horizontal analysis is also known as trend analysis. It's a financial statement analysis technique in which an analyst, what's happening here? In which an analyst compares ratios or line items in a company's financial statements over a certain period of time. It shows the changes in the amounts of a financial statement item over a period of time. For example, change in sales over a period of time. It is an extremely useful tool to evaluate the trends developing, hence the name trend analysis. So this can be performed on both the financial statement figures as well as the ratios you have computed to find out the trends in those figures or in the ratios. And horizontal trend analysis is along the horizontal line. So what you are doing is you are computing the change over time in a figure. So let's see how that works. For example, we have last year's sales figure. Again, you can use any time or data time period that you want. We are using quarters here, you can use years here, you can use months, you can use weeks, etc. So for our one product, the last year's sale in Q1 was $10,000, Q2 $12,000, Q3 $10,000, Q4 $12,000. Then we have this year's sales goals for the quarters, then actual sales for the quarters, variance for the quarter, etc., etc. And we have done this for 3 product lines. And then we represent them on a graph to show you the trend. We can write down the trend in numerical figures, in percentage figures, but for top management, it's best depicted in graphical representation. So we can see that the revenue is constantly growing. There have been downward trends, but overall it's upward sloping in chart 1. And we can see that the debt had been stable, but has increased over the last year. The debt was quite stable till 2003, then went on increasing in 2004, decreased in 2005, jumped materially in 2006, and was drastically reduced in 2007, but has increased again in 2008. This is on?
Yes. This
okay. Then you can see in chart number 2, where we are comparing net cash from operations and reported net profits, that our reported net profit is continuously upward trending. And over the last couple of years, it has somewhat slowed down in terms of the growth, especially when we compare it from the period from 2004 to 2006. It was drastically upward trending. It is still increasing, but at a slower pace. Now compare that with net cash from operations, which is increasing, but has developed a stable upwarding trend. Then we can see the chart 3, where we have compared the dividend per share with reported net earnings per share. While our reported net earnings per share have stabilized with a slight upward trend, our dividend per share has developed a slight downward trend. So we need to find out why this is the case. It may be that the company is retaining the profits so that it can capitalize on the market opportunity with the cheaper finance, resulting in increased value of the share by which it aims to pay back its shareholders. In graph 4, we have compared operational cash to net profit to operational profit to net profit to operational cash to debt. So the idea is this: you can take any number of figures, you can take any ratios, and you can see how they have changed, the trend that has been established along the horizontal line, along the time period. So if we want to do the horizontal analysis for our company, let's say in sales, let's go to the index where they have presented us 6 years data. It's page number 71. So let's go to page 71. So here we have the 6 years data. We can take this data and see how the trend has established over the time period, the horizontal analysis. So here we can see our production over time period, the cement production over time period. Here we can see the equity and the balance sheet footing over time period. Here we can see our gross profit margin over time period. Then we can see our debt to equity percentage has been constantly increasing. Then we can see our return on earning without fair value reserves has drastically come down. In financial year 2010 and 11, it was very low, but since then it has actually drastically increased. And it slowed down in 2014, and it has increased again in 2015, but hasn't reached, although it's very close to the level of the peak that was reached in financial year 2013. Our current ratio is also good, but has decreased from financial year 2014. Interest coverage has shoot up, and we know that's largely because we paid off a huge chunk of our debt. Then we can see the dividend payout ratio. So you can see all these figures can be used, all these ratios can be used to develop a trend analysis along a time line over a time period. Now the question is, what about the vertical analysis? Now we know the horizontal analysis. The trend analysis basically sees the percentage change in ratios or the figures in the financial statement over a period of time. That period of time can be selected by you. It can be a year, it can be a month, it can be a quarter, it can be a week, whatever you are comfortable with. So what about vertical analysis? Before I go in vertical analysis, if you have any confusion or question about the horizontal analysis or trend analysis, please feel free to ask. Okay, we have questions coming in. Most of these were the feedbacks. Then we have Wajahat Umar Pirzada Saab asking why the revenue is compared with total debt instead of expenses in chart 1. It's just what the company wanted, Wajahat. You can compare it with something else too. They just wanted to see whether the increase in revenue has justified taking on additional debt. That's one way of looking at it. You can put any graphical representation depending on what kind of information you want to drive and show the top management or your investor, your client, depending on which area you are in. A quick review, sir, but I just gave it. Okay, very quickly again, Akif requested to repeat it, so I'll do it quickly. Horizontal analysis or trend analysis basically is we take the line items, different financial figures in the financial statement or the ratios, and see how they change over a period of time, year to year, week to week, day to day, month to month, quarter to quarter. And in doing so, we are able to establish a trend over a period of time in those figures or ratios. And that gives us an indication of the direction in which the company is going. And when you put that in graph, it's one of the best information tool that you can give to senior management or client, where it's showing the actual end result in a graphical representation, which would take minimal time for the human eye to see and absorb. Faisal Manzoor asks, sir, why it's getting tricky now? A little commentary from your side will be more appreciated because we are getting on the advanced level. I hope the commentary from my side made it more clear. If you have any confusion, feel free to ask. That's why I'm saying ask any question. No question is a stupid question. If you don't have any question, then I have some. Fahad, really a good recap of horizontal analysis. Thank you, Fahad. And do remember, it's also referred to as the trend analysis. Trend, horizontal along horizontal line, vertical along vertical line. We'll see what the vertical mean in a bit. So if you have any other questions, please feel free to ask. Otherwise, we'll keep going and then I'll ask you some questions. Okay, no questions coming, so I'm assuming everything's good. Let's do the vertical analysis. And then we just get a question from Rizwan Hassan Khwaja Sahab. So the horizontal analysis is like a trend analysis of the cubes. Horizontal analysis is trend analysis. A horizontal or trend analysis can be performed on whatever you want. Your production levels, your sales figure, your net profit figure, your total assets figure, your equity figure, your debt figure, your ratios that you have computed. The idea is to see the changes that have been occurring over a period of time. And you can also customize the period of time you want. You can see the changes from day to day in important areas, week to week in others, month to month in others, and year to year in yet others. You can also look at the figures, the changes in them or in the ratios from quarter to quarter. So I hope that answers and clarifies this. So let's move on to one of the last segments of the day, the vertical analysis. So now we know what horizontal analysis is. And this is a very good way of remembering it. If you remember the graph, the x-axis is horizontal. So in horizontal or trend analysis, basically you are taking one figure sales and along the time period, just like in a horizontal axis, you are seeing the changes. So what is the vertical analysis? Vertical analysis is an analytical technique that states each account balance, now pay attention, each account balance on a financial statement as a percentage of a base amount on that financial statement. What do we mean? Let me show you. Let's go to our financial statements. Let's say I want to perform vertical analysis on my profit and loss account. What would I do? One way I can do it is sales is a major important figure. I'll take it as a base figure and I'll take every other figure and divide it by sales to see what is the vertical analytical results if sales is taken as a base amount. For example, cost of sales divided by sales. How much is that? Gross profit divided by sales. Admin expenses as a proportion of sales. Selling distribution expenses as a proportion of sale. Other operating expenses as a proportion of sale. Other income as a proportion of sale. Finance cost as a proportion of sale. Taxation as a proportion of sale. Profit after taxation as a proportion of sales. And some of our ratios are vertical analysis. For example, which one? Net profit divided by sales, net profit margin, vertical analysis. Gross profit divided by sales, gross profit margin, vertical analysis. There you go. And so on and so on. We can do the same with our balance sheet as well. Let's say I want to compute everything as a percentage of total assets. So I'll take long-term assets as a proportion of total assets, current assets as a proportion of total assets, or even subdivisions, store spares as a proportion of total assets, stock in trade as a proportion of total assets. So I hope you got the idea. Let me also show you here how they have performed their vertical analysis. They have their vertical analysis on page 77 and horizontal on 81. Okay, this is the vertical analysis of profit and loss account. What they are doing here is, just like I've told you, they have taken other income as a percentage of sales, and you can see that it has increased in financial year 2015, and there have been an upward trend in the last 4 years. Then they have taken this graphical representation where you can see all the components, and then you can take them as a proportion of sales if you wish to. Here you also have the horizontal analysis where the changes are computed over time period. Here you can see all the figures are put in for the last 5 years, and the changes are computed for the last 5 years. For example, shareholders equity was 26,519,220 in 2010, was 32,17,285. So year to year change was 13.94, then 8.88, then 45.77, then 28.27, then 1.27. Both horizontal and vertical analysis can be represented in graphical form to make it more meaningful. Remember, the higher you go up the management hierarchy, the lesser time there is available. And in those, the graphs become very useful for you to make the representation. Look at here, just in a figure, you can see the trend in sales, in cost of goods sold, in cost, gross profit, in other income, etc., etc. These are just tools to represent the information that we have gathered. So for balance sheet, we can take the account balance of all individual balance sheet items as a proportion of total assets. For income statement or profit and loss account, to perform the vertical analysis, we can take all account balances as a proportion of net sales or revenue. Vertical analysis basically reports each line item of a financial statement as a representation of the percentage of that financial statement's main focus or the base item. Just like for the P&L, we chose sales to be the base item. Certainly, you can choose any base item depending on your objective, what you want to achieve from that financial statement. For an income statement, each line item can be representative of gross sales. Normally, that is the way it's done. On the balance sheet, each line item can be representative of total assets. In a cash flow statement, each line item can be expressed as a percentage of the firm's total cash and cash equivalents. Vertical analysis allows for a company's financial statements to be represented within a standard process across all industries. A snapshot can be taken of a company's financial position by line items. It also allows for easy comparisons to previous periods for timeline analysis, including annual, quarter, and sequential quarter analysis, and analysis of longer time periods, such as 5 years or 3. Before we compare horizontal and vertical analysis, if you have any questions, please feel free to ask. I have a couple of questions. Okay. One question is, so basically, vertical analysis is ratio analysis. Well, ratio is comparing figures with figures, so in that way, yes. But you would see many of these vertical analysis would be different from your traditional ratios. For example, you'll be comparing stock and spares to total assets. You'll be comparing stock and trade to total assets. So these would give you additional bits of information which would be more meaningful in driving the information about the company, maybe as a client, maybe as an investment prospect, maybe as a potential customer to loan out to, maybe as an employee to give meaningful information to management, whatever role you are in. So it's so sir, sales would always be base amount in vertical analysis of profit and loss account. Mostly it is, but not always. If you want to drive certain information, you can change a base figure, maybe the net profit. But normally the sales is taken as the base figure. Javed Akhtar, sir, would you like to give any example of ratio which have both characteristics, that vertical and horizontal? Many. If you take the net profit margin, that's a vertical ratio. But if you check it across time period, that becomes the horizontal and trend analysis. Mason Ladha, hello. Apologies for not being able to attend from the start, and thank you for arranging this session. That's okay, Mason, and you are most welcome. Welcome for joining in. I might have missed it in the beginning, but would we be discussing how to interpret the numbers that are calculated after an analysis is performed? Yes, Mason, we have discussed that in extensive detail, how to not only interpret the numbers, but how to investigate, how to correlate them with other ratios, how to correlate the information, how to draw the complete bigger picture. The recording of this session will be available online on YouTube and Mobile News. So I suggest for the part that you have missed, go through that and you'll be able to see that. Any confusion, shoot me an email. I'll be sharing my contact details shortly. Mohsen Ikram, is current ratio vertical analysis? Well, if you want to compare everything with current liabilities, then it can be. Yeah, why not? Khwaja Muhammad, I think we can have horizontal or trend analysis of our selected ratios. Yes, we can, Khwaja Sahab. Faisal Manzoor, so for vertical analysis, what should be the basis to decide what figure to take as a base figure? Very good, Faisal. If you have no specific purpose, then you can take generic figures, like for P&L, take total sales or net sales. For balance sheet, take total assets. If you have any specific purpose, then you will need to select that figure. If you want to see everything in comparison to net profit, then you need to take net profit as a base figure for vertical analysis. I hope that helps. Hayan Heather, horizontal and vertical analysis is for external stakeholders or for internal management use only. It seems like it can be manipulated easily. Hayan, anything can be manipulated, but being a professional, it's our duty to avoid manipulation and see through the manipulation, right? Good. Now it can be used for both purposes, external as well as internal. It depends on how you want to take it. Just bear with me for a moment. Sorry about that. Okay. So SNRF is asking, can we synchronize these both analysis? Of course, all these tools complement each other in order to drive a meaningful information and analysis. Muzammil Holia, what is the base amount of vertical analysis of liabilities and equity? Well, Muzammil, you'll be analyzing the balance sheet. So if you don't have any specific objective, then you can take total assets to be the baseline, as I explained. SNRF, like we do vertical analysis for a timeline for over a 5-year period. So I assume SN is trying to ask what should be the time period for a horizontal vertical analysis, just like for horizontal analysis. Well, SN, it can be for any time period. Basically, you are focusing on one time period and you are seeing how in vertical analysis, how every figure in the financial statement come up as a proportion of the base figure. That is different from finding a trend over time. But there is nothing stopping you in finding the trend in vertical analysis. The net result that you are getting, you can always interpolate that over a time period to see the trend that would be developed over a time period. For example, admin expenses by sales, you can see how that has changed over the last 5 years. So nothing stopping you to correlate both and use trend analysis on the vertical analysis results. Misam Latha, thank you, you are welcome. Mohsin Ikram, I missed the answer previously due to bad connections. Can we use results from vertical analysis to create horizontal analysis? How informative the trend would be? Well, Mohsin, your lucky day. I just answered that again. So I hope that answers your question. Sufyan Iqbal. Oh, good to have you, Sufyan. Hope you are well. Thanks. Very good session. Arrange a session from audit point of view, how an auditor should approach annual report, and share your tips regarding audit. That's a good suggestion, Sufyan. Send an email to members affairs to suggest this topic, or send me an email and I'll share with them, and hopefully we can plan a session on that. We will also have a second part of this series, as I shared in the intro, where we would be looking at more complicated aspects of financial statement analysis being used in practice in line, especially with the focus on financial services industry. Rehan Yusuf, interpolate is a projection or analysis of past trend. Interpolate is a projection. You can also do it backward for last 5 years, or interpolate for the future using your forecasts. Ijazul Haq, very nice session. Thank you, Ijaz. Faisal Manzoor, sir, are ratios being calculated using balance sheet and P&L numbers also vertical? Some of them are. When they are using the figures from the same financial statement, then they are practically vertical analysis. Vertical, same financial statement on a vertical line. When you are using one figure from balance sheet, one from P&L or cash flow statement, then it's not vertical analysis. So I think most of the questions are answered. In fact, all the questions that I got are answered. If you have any more questions, please feel free to ask. Meanwhile, I'll ask you the last question of the day. So our last question of the day is, which of the following is not part of the financial statement analysis tools? Ratio analysis, horizontal analysis, vertical analysis, or systems analysis? You have 30 seconds to answer. Just type in the answer in the questions box. And we have the answers coming in. Wow, fantastic. System analysis. All of you are right. Who was the first one to answer? I'll just name him. Faisal Manzoor. Well done, Faisal. Good. Well done, guys. So if you have any question, ask them now. Zahra Aziz, kindly do shed light on comparing debt to equity and gearing, as I have asked before. Oh yeah, Zahra, in debt to equity, we are comparing the level of debt within the company as compared to equity. In gearing, we are computing debt as a proportion of total capital in the company. Total capital include both debt and equity. And when we are comparing debt to equity, we are only seeing how much debt is there as compared to equity funding. That's the prime difference. I hope that answers. Fakhr Hayat, good and appreciated to ACCA and you, sir, to provide such a good webinar. Thank you, Fakhr. We hope this was informative and added value to you. And we are still getting system analysis as a right answer, which is correct. So let
Don't
us.
close.
The word file.
The word file.
Our system has slowed down. So let's finish off the session and I'll take your remaining questions afterwards. What are you listening to?
I'm listening to you, checking that if everything is working fine.
Horizontal versus vertical analysis. While horizontal analysis make comparisons of numbers or amounts in time, the vertical analysis involves displaying these numbers as a percentage of a total in order to compare them. Both are useful financial analysis techniques that calculate relationships between figures in balance sheet and income statement. And as I've shared with you, they are not mutually exclusive. In fact, they can be shared, they can be used in coherence, so much so that even trend analysis or horizontal analysis can be performed on the figures that you have computed from the vertical analysis, as we discussed. And again, if you have any questions, you can ask. As I promised, here are my contact details. You have the presentation. Even later on, if you have any questions, feel free to ask. As chair of MNP2, even if you have any career confusion or need advisory other than this technical topic, please feel free to ask and I'll be more than happy to assist. It may be that I might not be able to get back to you immediately because most of the time I'm busy in meetings, stuff, work, etc. But inshallah, I will get back to you. That's something I take pride in, and I do that. The best way is to send me an email with your intro and do mention you attended this session and your brief professional intro if possible. And if you send me a message on WhatsApp, do mention your name and that you attended this session. So if you have any questions, which I can see you have, we still have last 10 minutes and we can answer them. See, I promised I will try my best not to leave any question unanswered. So Raja Junaid is saying, why don't you read the questions and I'll answer?
I recall the question. Raja Junaid said, in vertical analysis, can we use total assets as a baseline against analysis of liabilities?
Of course, Raja. In fact, we can use, and we normally use total asset as a baseline for analysis against all the line items in the balance sheet. That's the concept of the vertical analysis. You are comparing all the line items against the base items. So you can use that for liabilities too.
And Talha Mohammed Javed asking, technically horizontal analysis is a trend analysis in short and it can be shown in percentage, whereas vertical analysis is an analysis of two different components of a financial statement shown in percentage terms or relative terms.
Almost there. The thing is, horizontal analysis is a trend analysis, yes. And in vertical analysis, you are comparing line items of the same financial statement. Other than that, you're right. Read it.
Hassan Raza saying,
No, read this. Read this. You have to read all.
In the end.
No,
Okay.
right now.
Okay.
In the way it's coming.
Zara Aziz saying thanks and it was a nice session.
You're welcome, Zara. Thanks. We hope it was beneficial for you.
Fatma saying thank you. This webinar was a good refresher to knowledge.
You are most welcome, Fatma. We are glad it was of value.
Hassan Raza asking here in UAE, we have different timing. So we'll be going for prayer at 2:15 minutes.
Great, Hassan. The session is ending in 8 minutes anyway, so you are free to go.
It's from 10:30 to 2:30.
It's still 2:30.
Yes.
Okay, great. Well, we have concluded the session. If there are any questions, we can take care of that. Carry on.
Okay, the other one is from Fakhar Hayat. He is also saying thanks to you.
You're welcome.
Mohammed Awais saying many thanks, Mr. Umar, great work.
You are most welcome, Awais. Keep on attending these sessions and share your feedbacks. And all of you, any suggestions for any future topic you would like to see the sessions on?
After Barkatali saying total capital is equal to equity plus long-term debt.
He's asking.
He's asking something which.
Of course, yes. You know the accounting equation, total assets plus liabilities is equal to capital. So same concept, total capital is equal to equity plus your total. Dania West is saying, thanks, it was a useful webinar. You are welcome, Dania. Muzammil Kholia, RBDC. Are we connected?
Yes, we are connected.
Okay. You went to get that. I thought we got disconnected.
No, I am trying at least to do it a good twist to have an interactive session. We will allow some participants to participate through their microphone, sending their questions.
Oh,
so
how
because
would you manage that with hundreds of participants?
We can allow one by one.
One by one.
One by one.
Okay, that's good.
The person who want to send their question shall raise their hand. So
how will they raise their hands?
We have the list of attendees there.
Okay.
Just pop it out.
Okay.
And yes, first we have to raise down their hands. It's in.
They'll have to click this. They have this in there. Okay, great. Great idea. Muzammil Kholia, very informative session, sir. Looking forward to have more training webinars from your side. Thank you, Muzammil. Inshallah, we'll continue on doing that. Dania West, what is the next scheduled webinar? You'll have to check that with the members affairs. Just send them an email, or we can ask the representative with us. Hayam, when is the next webinar?
On financial statement analysis.
Yes.
It's with the, it is contingent on the availability of Mr. Sadali Sharif. And
hopefully we'll have that within next week. We'll keep you posted. After Barkat Ali, long-term debts mean including all the long-term liability or only loans? Well, in debts, you add only the borrowings, especially when you are analyzing from the debt perspective. Usman Pervez, excellent session. Thank you, Usman. Very kind of you. Dania West. I'm very much looking forward to the next session. Thank you, Dania. We too are looking forward to welcoming you in the next session. Mohammad Faik Durrani, good seminar, refreshing all in one. Thank you, Faik. Bilal Hidayat. Thank you. I work in a non-profit organization and we don't use most of the ratios. It was a good refresher. You are welcome, Bilal. Obviously, you have to customize it as per your needs. Bilal, please arrange one on deferred tax if possible. Okay, good suggestion. Khayyam will pass this on to the members of affairs team and they will surely consider that. Umair Sheikh, thank you so much, Umar. Wonderful info session and revision of concepts. Hope to see you doing these more in future. All the best. Thank you, Umair. Sure, look forward to welcoming you. Thank you, sir. A very useful session. Mohammed.
So use your Yes, now the voice.
Okay. Okay, Zara, we have done this session today on analytical, common analytical tools, and we'll be covering some more in the next session. And after that, if you want one focused on the financial services investment tools, do send an email to member services or send me an email and I'll forward them. And hopefully we'll have a session on that too. Muhammad Mushtaba Bashir. Many thanks, Umar. You are welcome, Mushtaba. Kindly arrange more CPD events as it is part of our membership. Of course, and I do believe there have been a lot of CPDs going on, and we are planning to do a lot on local laws and taxation as well, the area where we would like to strengthen our member space even more. Currently, we all members are facing much difficulties in finding CPD events organized from ACC. Why? My email
We
box
have-
is like full with emails from
Even
ACC.
we have two CPD events today. One is yours, and the second one is coming from Vinolak on leadership series.
And when is that?
Just after you at 3 p.m.
At 3
Standard.
p.m. Pakistan time, which is 3:30 Indian Standard Time, and UAE time would be
It would be, I think, half
or before.
Yeah.
2:30 UAE time, and similarly other regional time it would be starting. So we have just two sessions today, but I'll ask the member affairs team to pass on the feedback. You need to increase the number of CPD events even further. That's the feedback. Faisal Manzoor, sir, I suggest to take real financial incident, negative, positive, that could be forecasted using ratio analysis, like a case study in next session. We are planning a few advanced things in the next session. As I've shared, Faisal, this is a two-part series. Today was basically the basic part, just to give you some refresher as well as the idea how to interpret, interrelate, correlate, and look at the bigger picture and the horizontal, vertical analysis, etc. Building on this, we'll conclude this in the next session, inshallah, and you'll find that even more interesting. Muhammad Raza, thanks. You're welcome, Raza. Rizwan Hassan Khwaja, for future topics, how can we use data sciences to analyze online financial statements, comparing with data available of our subject organization? Oh, Rizwan, this is one of the topics I've recommended. Shoot an email. Again, you do remember data analytics, blockchains,
Yes.
artificial intelligence, so
Yes.
same thing. Because these are in-demand things and topics of the future, so certainly we should be doing them. Muhammad Raza, thanks, you're welcome. Hassan Raza, ho gaya. Muhammad Ahmed Kamal Khan, thank you for this informative session. Can you please share a brief list of contents for session 2? Yes, Ahmed, when you'll receive the invite for session 2, just like in this session, that would contain a list of contents. You will have the topic index in that. Mohsen Ikram, thank you for the informative session. You are most welcome, Mohsen. Muhammad Umair, they are very informative. The way you describe the horizontal trend analysis is awesome. Thank you for such a wonderful session. You are most welcome, Umair. I'm humbled and glad it was of value. Noreen Badani, thanks for this session. Really appreciate it. You are most welcome, Noreen. We look forward to having you in future too. Shoaib Abrar, thank you. You are welcome. Zara Aziz, it will be better to arrange webinar in the evening, but the Pakistan time as 9 a.m. to 6 p.m. are the job timings. That's the challenge, Zara. Our ACCA team also have an office timing here. So I have no issue. I mean, my evenings normally are devoted to the professional or social front anyway, but I think it would be a challenge for the ACCA team. But still feel free to pass on your suggestion, and I'm sure they'll give it a considerate thought. Faisal Wahid, very informative. Thank you. Yasser Ammar Mahmood, thank you so much. You are welcome. Ali Ahmed, thank you, sir, for this informative session. Akib Shah, mentoring by you on any subject is always useful. Thanks a lot, sir. You are most welcome, Akib. Seems like Akib has been attending my sessions previously too. It's an honor. It was a very good session. You are most welcome. Sufyan, arrange a webinar on financial statement of Islamic bank like Mizan Bank. Good idea, Sufyan. Shoot an email and I'll pass that on to the CPD team. Noor Ali Bhayani, thank you, ACCA. It was a great session and surely helpful. You are most welcome, Noor. Umair Ali, thank you, sir, for this informative session. You are most welcome, Umair. But it would be great too if the time would have been little later. Well, same thing as Zara, so same answer. Ali Zahir informative session. Thanks to you and the ACCA team. You are most welcome, Ali Sahab. Ali Sahab, by the way, is a partner at our firm, Millennium Law Incorporate Company, the pioneer ACCA and legal tax practicing firm in Pakistan. Okay, so we have something very special for you coming from our CPD team. I'll pass on the mic to Khayyam now.
Just give me the mouse. So those attendees who want to ask question live, they are given chance to ask question from Mr. Umar Zahir, and those who wish to ask question live through microphone must raise their hand. And let me tell you that before raising hand, please make sure that your microphone is working properly, and also make sure that it is noise free. So all the participants are requested to raise their hand. We have one from...
Some may be the first timers, so if you could guide them how to raise the hand too.
Okay, let me show you. It's
You can just describe it or
however.
okay.
Okay, guys, just follow my steps. There is an attendee tab in this dialog box, and you have to pop it out, and then you can see that there is an option that you can raise your hand if you want to use your microphone and communicate your questions to us. Right now we have Mr. Amanat Ali, who has been waiting since long.
One thing. They would only have their name showing, right?
Yes.
So to raise their hand, they'll need to click on that hand icon or what?
Hand icon.
So you need to click on the hand icon. Okay, great. Yes, let's go with Amanat.
I am going to give the opportunity to Mr. Amanat Ali. Yes, Mr. Amanat Ali, you can ask your question now. Please make sure that your phone is working.
Bear with us, Amanat. Can't hear you. We are checking the sound adjustments here. Can you please also check at your end whether your mic is functioning properly?
Your microphone is never transmitting your voice. Okay.
Minimize this. No, that one. The background browser. Yeah. Close this to red box.
This
No, it's fine.
Anybody else who want to? Okay, Imran Abbas also want to say something.
Sure.
Listen through the background. Okay, Imran, I'm going to unmute you.
रेवेन्यू वगैरह कोई उसके जो मतलब कोई ट्रेनिंग है जो उसको नहीं है वो देखेंगे जब हाँ ये हमारा मतलब ये काफी लोग आ जाते हैं उसमें आप जो किसी से हाँ बताइए 20% से जो आप धन्यवाद वहाँ पे 4 मेरे दोस्त हैं और इसलिए वो नहीं कर सकते
Can you? Yes, I can.
मुझे पता है कि उनकी क्या
Done?
दे दूंगा इसके बाद जो हमारा जैसा
Ram sir, we can hear you now.
हमारा जो काम होता है हमारा जैसा
कौन से लाइन होता है
जो भी गवर्नमेंट है
फिर कपड़े
No. Okay, Shweb
Okay,
sir.
okay, Shoaib, we are going to allow you so that you can communicate with us. I'm going to unmute you. Yes, Shoaib.
Assalamu alaikum, Shweb sir.
Yes, Shoaib, are you there?
Shweb is also busy now. Give someone else a chance.
Okay, I'm going to lower all the hands of all the attendees, and
Those who
those who
want to
want to speak up should raise their hand once again, so that we know who are actually available right now. And please make sure that you should also communicate when we allow, because we have came across at least 2 people who don't send their questions. Now you are all allowed once again to raise your hand.
and you'll just need to click on the raise hand icon.
Okay,
Abdul
yes, we
Salam.
got Abdul Salam. Abdul Salam, I'm going to unmute you.
Assalamu alaikum, Abdul Salam sir. How are you?
Mr. Abdul Salam, are you there? Like his microphone was not working.
Abdul Salam, can you please check your microphone and raise your hand again? We are going to move on. Up. There is someone.
Yes.
Mohsin Ikram sir. Mohsin sir, we are going to give you the chance to put your question across. Assalamu alaikum. Speak now.
Hello, sir. Hello.
Ji, Assalamu alaikum. We can hear you, Mohsin sir.
And
Walaikum salam. Yes. Thank you for giving me the opportunity, sir. And actually, my question is not linked to this session, but a session which is like about income tax returns. So, do you have any plan to have a webinar or any other session on income tax return for the individuals?
Yeah, it has been planned, and I think it should be coming up within this month. I do know certainly that it is planned and is in the pipeline, but do shoot an email to Harun Saab or send me so we can forward this to relevant team to show the interest in the session, and then maybe it can be speed up for you.
Okay. Yeah. Thank you.
You're most welcome. Thank you. Next, we have Mudassir Khan Sahab. Mudassir Sahab, you will be given an opportunity to share your question now. Ji, Mudassir Sahab,
Assalamu alaikum. Walaikum assalam. Omar, can you hear me? Hello?
Ji, we can hear you. Please speak up.
Okay. My question is related to is ACC is planning any IFRS related webinar?
IFRS related webinars.
Yes. There have been several IFRS related webinars, and I think all of them have been covered?
For last year, all of them were covered in around, I think, March, April.
Okay.
And current year IFRS webinars will be expected to happen in December 2018.
So the next in line will be in around December. Meanwhile, the recordings of the IFRS sessions are available online on ACCS channel on YouTube and Vine.
Okay, thank you very much.
You're most welcome. Next.
No one else, I think.
Okay. So if anyone else has any question or feedback, feel free to raise your hand. इसका आप करेंगे आप मिस करेंगे क्योंकि hundreds of attendees है, इसको आपको slowly scroll up करना होगा. So there's no one else. So let's just quickly look at the question section. If there are any questions, great. Otherwise, we'll conclude this session. Okay, so I guess we have.
Yes.
Okay. Faisal Manzoor, sessions early in the morning are the best. But then Faisal, some people think that it's more challenging because it's during the peak working hour. But share your suggestion. Hassan Raza, can we have session on consolidation and financial modeling? I do remember there has been a session on financial modeling and the recording is available.
Well, and we are also working to repeat those sessions and introduce some new on financial modeling. Currently, we are in this discussion with Mr. Khurram Khan, and hopefully he will be doing those webinars on financial modeling.
Great. Fakhr Hayat, thanks to ACC Pakistan team and webinar operating team. You mean Khayyam? Thank you, Khayyam.
Thank you so much.
Then we have a smile from Faisal Manzoor. Thank you. If the person is not responsive, better close the mic immediately. Okay. Rabia Shams, as requested by one of member for the deferred tax session, I would like to request you to arrange the session either on a Friday or Saturday. Perfect. I normally prefer them on Saturdays anyway.
Yes.
Ramesh Kumar, can I get this PDF please, as I did not receive it? Ramesh, they are available in the handout section. You can just download it from there. Asun Raza, thank you sir, you are welcome. Next, thank you sir, you are welcome. Osama Muhammad Rashid, any plans for Basil? Oh yes, see, all the topics I told you.
Yes.
So answer, when have
Please
you planned Basil?
share your feedback at members.pk@accglobal.com or send directly to harun.chan@accglobal.com. I think we should run the poll now, feedback poll.
Yeah, sure.
That's at the bottom.
Dilshad Ahmed, please arrange a webinar for individual tax return filing. Inshallah, Dilshad, that's in the pipeline. Thank you all. You have been very attentive and it's really good to have you here. And we are just gonna run a feedback poll for today's session. Please share your feedback. How do you believe was today's session? So we can get your feedback and try to improve it. And how much time is there for the?
I think they should be at least 1.5 minutes because some people are.
Allow 2 minutes. We have the luxury of time. We covered all the content in a timely fashion.
And in the meantime, I think I should upload these files at Google Doc link so that they can download from there
It's a
later on,
very
or
good
maybe
idea.
during the session, because we have at least 10 more minutes
It's a
that
very
can be
good idea.
utilized.
True. Should you have any questions, feel free to contact. You have the presentation and all available. Khayyam is also uploading it on Google Docs, so you'll be able to download it from there too for your references. Last 30 seconds, come on, vote guys. You are very valuable to us. Let us know your feedback.
So far, 36% people have voted, while we have around, I think, more than 250 members. It's 260. So I think at least more than 100 should vote and give their feedback.
Normally, it's a trend. The motivation to vote is lower, and normally, as a natural, we are inclined not or select the lesser option. Congratulations, your target achieved and exceeded.
Yes. So you have to close the poll.
So should we close it now?
Yes.
You sure? I'll give them 30 seconds. Let
Okay,
a few more people.
we can give them, allow some more time. It is getting better now.
Okay, guys. Thank you very much for your feedback. And it's been great having you here. Your feedback is noted. Please feel free to let us know the topics you'll be interested in. And that's it from me for today. Have a good weekend. Take care of yourself. See you next time around.
And please give me at least 5 minutes so that I can upload those files. And I will be sharing the link, the Google Doc link with you, so that you guys can also download those documents from the Google Doc link. Thank you, everyone.
Allah Hafiz.
Yes. Okay, guys, I am going to share the Google Doc link so that you can download all the documents of this session from there. And that is available in your question dialog box. Please have your link and also tell that you have received in the question box. I'm also going to send it through the chat box to all the audience and to all the participants. Please inform that if you have received the link. Khurram Adil saying yes, received, thanks. So that is all for today, and have a nice afternoon, and I hope you have gained value from this session and reflect this in your profession as well. I must make another announcement that soon after half an hour, there is another session on practicing leadership. So you all guys are welcome in that session as well. Thank you everyone. Allah Hafiz.